The market is really getting ahead of itself.
There is, I think, some risk in the market just from a valuation standpoint.
There's this contrast between what the bond market thinks and what the equity market thinks.
This market is pricing the Fed to return to a neutral stance for monetary policy.
It's not about whether they go in September anymore. I mean, that debate is over.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday, coming off the back of the biggest one-day loss on the S&P 500 in around about 2 weeks. Your scores this morning look like this. Equity futures on the S&P 500 firmer by 0.5%. The Nasdaq 100 doing nicely, up by almost 0.75%. The small caps, the Russell, up by 0.5%. The fate of this market, the price action in the hands of one man, Chairman Powell of the Federal Reserve, out in Jackson Hole, Wyoming. That address begins at 10 a.m. Eastern Time. We've been anticipating this speech all week. And 3 weeks ago, for many, this would have been a very, very different address following that August 2nd payrolls report for the month of July. And people started talking about 50 and maybe even an emergency rate cut. 3 weeks later, I have to say things are a whole lot calmer. We've heard from Fed Presidents Collins, Harker, Schmidt, none of those Fed officials flagging any real urgency. And you can thank the recent economic data. 3 weeks of jobless claims, subdued jobless claims, just maybe calming things down just a little bit and putting some fuel into some high yields over the last 24 hours. So check out the bond market. The 2-year back through 4%. If we can take a look at the 10-year together and the cross-asset board, the 10-year shaping up as follows. Yields just about unchanged at 385.39. A big focus on foreign exchange over the last month or so. Dollar weakness absolutely dominating things. 5 weeks of dollar weakness on the cards here. The longest weekly losing streak for the greenback for the year so far. Euro dollar 111.16. Big morning ahead then, big hour ahead. We'll catch up with Stuart Kaiser of Citi ahead of Chair Powell's remarks in Jackson Hole, Isaac Boltanski of BTIG as Harris accepts the Democratic nomination, and Ian Shepherdson of Pantheon saying the Fed should have eased back in March. We begin with our top story. Stocks moving higher ahead of Fed Chair Jay Powell's remarks at 10 a.m. Eastern Time. Stuart Kaiser of Citi expecting Powell to cement a 25 basis point cut in September and writing the following. There is a low probability the chair would pre-commit to larger cuts ahead of August payrolls and another CPI print. Stocks might initially respond positively to that dovish shift, but it would also raise questions about how worried the Fed is about growth. Stuart's with us for the next couple of hours. Stuart, good morning to you.
Good morning. How are you?
Let's get to that speech. What are you looking for from Chairman Powell in Jackson Hole this morning?
I think the question is he going to sound more like the Fed minutes, or is he going to sound a little bit more like the Fed officials that have spoken since then, right? So the Fed minutes, a vast majority of participants think a cut's appropriate. That's going to sound a little more dovish. It did seem like Fed officials the last couple of days tried to kind of walk that back, half a step or so. So I think it'll just be the question of where does Powell kind of fall on that spectrum? Does he sound more dovish, or is he a little bit more conservative based on the data you mentioned?
Do you think unanimity is important to the Federal Reserve Chair? Because when I listen to the likes of Boston Fed President Collins has come out in the last 24 hours and said no real need for urgency here. If she's saying no real need for urgency, could we expect to hear any real need for urgency in that address later on this morning?
I don't think I think the Fed, the last couple meetings, frankly, has really tried to guide the market back to center lane. So that's where I think he'd want to get. I don't think he wants to suggest the Fed is super urgent in either direction, especially right now, because there's only one direction they're going to go, right, which is to cut rates. So if there's a lot of urgency in that direction, I think what he's telling you is he's legitimately worried about the growth outlook. And I don't really think that's a message he necessarily wants to send to the market.
This market right now doesn't seem legitimately worried about the growth outlook if you're looking at the performance of equities. We've had a series of all-time highs on the equal weight on the S&P 500 this week. We've had certain days where small caps have started to re-establish leadership as well. Based on that, it feels like this market is priced for a soft landing, and at the same time it wants the rate cuts typically associated with a hard one. Is that a disconnect that you think needs to be resolved?
It is a little bit of a disconnect, I would agree. I think 50 basis points in September is actually bad for equities, in my view, because I think if it's, let's say it's 25 basis points and the next 25 is data dependent, so to speak, the data dependency is on the payrolls report on September 6th. So to get 50, you'd kind of need a weak payrolls report. And as you know, we've been very much own equities until payrolls weaken. So, my view would be if you get 50, it's probably not necessarily a good thing for equity markets. The markets do want to have their cake and eat it too, without a doubt. And that's why small cap has been so popular, right? It's if you get 150 to 200K jobs, let's say, as a number at the beginning of September, and then they cut 25. Well, now you're in a situation where you're soft landing with insurance cuts. And our view has long been that is kind of the uber bull case for markets. So, yeah, the market would love it. I don't think the market's going to get strong labor markets and 50 basis points. So they're going to have to give up one of those things. And if I'm an equity investor, I'm willing to give up 25 basis points of cuts to keep that labor market working.
Things have changed a lot in the last 3 weeks. I started the program by going back to August 2nd. Do you think about where we were August 2nd? Even you were considering pulling back on risk because this might be the beginning of weak labor market data. 3 weeks later, a string of decent jobless claims. It feels like we're back to where we were. Do you think we have actually introduced some two-way risk back into this market, or exactly where we were 3 weeks ago, just before we got that payroll print?
I think there's more two-way risk, and I think the risk reward is a lot worse now than it was a couple months ago. Just because when you get down to that near that 100K payrolls number, you're right on the borderline of where the market's going to really start to worry about things. So I do think the risk reward is worse. That said, to your point, the data we've gotten since then kind of makes that payrolls print look like the outlier rather than the trend. So if the data keeps in that direction, then equity markets are going to respond well to it. But the risk reward, I mean, how we phrased it is you spent 6 to 12 months in a higher for longer environment. That was how you traded the market. Strong growth, pushing out rate cuts, equities work. I think the market's kind of transitioned now to we're in a slowing growth environment. So now we have to trade slowing growth and decide whether it hard lands or soft lands. And we don't like the risk reward of that phase and nearly as much as we like the previous one.
There's a few risk events on the calendar. We've been through at least one. Chairman Powell, a little bit later this morning, we've touched on the other. The payrolls print of September 6th. The read on what happened in the month of August. Do you think we're underpricing that as a risk event at the moment based on what this market's been doing?
Yeah, 100%. To me, that's the single most important data point you'll get in the next 4 to 6 weeks. And potentially it sort of determines the FOMC outcome as well. So, yeah, I think there needs to be more risk priced into that. I think part of that is that this is August. And, the second part of that is you have a holiday weekend in between, which kind of, can play with vol pricing. But yeah, to me, that is the number one day you need to make sure you're in the office. So I think it should be priced a little more aggressively.
What do you think a bad data point would actually be? And then we can get to how you'd advocate positioning around it. 114 was the last print. Last time I looked at the median estimate of our survey for payrolls for the month of August, we were looking at about 155. That's based on 4 estimates. We'll get a whole lot more between now and then. What is bad for you? Is it sub 150, sub 100? What would bad news actually be?
Yeah, I think sub 150 is going to get people's attention. I think, let's say sub 125K, I would put in kind of the bad category. I think if you're in the double digits, markets are selling off, fairly aggressively on that. So we've sort of said 150 is the Mason-Dixon line. Whether it's actually 125, we could debate that. But I think sub 150 is definitely going to get people's attention because July is typically kind of a weaker month historically. So that number, I think, some folks are blaming that a little bit on seasonality. You don't have that same challenge in August. So if you get a weak print, and you're stacking them up back to back. So yeah, 150 or 125, anywhere below there you need to worry about.
You mentioned that August 2nd is starting to sound more and more like an outlier. How does the data stack up between the data and what we've heard from corporations at the moment? Because the guidance we get from the consumer-facing companies, I have to say, it's highly contradictory at the moment. You've got a series of companies, Williams and Sonoma yesterday, doing poorly. Then you hear from places like Ross Stores doing okay. Likewise on Walmart and Target, Home Depot suffering, Lowe's suffering. The list is like this long for companies struggling and this long for companies who don't see any weakness at all. What explains all that?
It's a good question. It seems like you're getting some trade down. So like a Walmart or Target that normally wouldn't have been the higher end consumer. It seems like the higher end consumer is finding their way into those stores a little bit. But to your point, this hasn't just been claims data. I mean, last week our view was that the Thursday data, which was Walmart claims and retail sales, was actually the more important group of data than CPI was. And you back up Walmart with Target. I think you're getting at least some message that the lower end consumer isn't under intense pressure. I agree it's a mixed story, but mixed story is better than what people were worried about after the August payrolls print, right?
Yeah, I said at 8:31 Eastern Time, August 2nd, ladies and gentlemen, welcome to a growth scare. Yep. In that moment, that's exactly what it was, and that growth scare has faded over the last 3 weeks. With everything we've talked about in the last 8 minutes in mind, what are you advocating for? I know you get super tactical. What are you suggesting people do between now and, say, September 6th, the next 2 weeks?
Yeah, I think you kind of want to run long risk between now and September 6th. I know it's a very tight window, but you're kind of in low volume markets. I think the trend has been set, which is sort of an upward trend in that period. And I think we will perform pretty well in there. I think you'll probably get a pretty friendly message from Chair Powell today as well. So I think you're a little bit bullish into that. But I think the main takeaway that we're hearing from institutional investors is even if I wanted to add risk. I'm in a low volume part of the year. September seasonals are horrible. And then I've also got this massive risk event the first week when I come back from vacation. So it's a little hard to just add a lot of core risk. The one benefit will be your kind of vol targety systematic funds are going to be under the surface, probably buying stocks for the next week or two. In a low volume environment, that kind of probably lifts you as well.
Is the trend for leadership set as well?
It's a good question. I don't think so. I think the leadership is still a little bit in flux because that payrolls print is going to it's going to at least set the tone, hard landing versus soft landing, let's say for the month of September. Those two trades are just like diametrically opposed to one another. So I think it is a little bit hard to know what to own. To your point, small cap has caught a bid, equal weight has caught a bid. That's earnings related. That the S&P 493 or whatever you want to call it actually produced year-on-year EPS growth this quarter. So there is a fundamental kind of underpinning to that trend. It's just hard for me to get fully behind a small cap trade if just given the risk reward around hard landing.
The S&P 1 reports next week. We'll spend some time on Nvidia a little bit later this morning. Stu's going to stick with us. If you're just joining us, welcome to the program. Equity futures on the S&P 500 firmer here by 0.5%. Absolutely stacked morning for you over in Jackson Hole. Bramo's there. We're going to catch up with her a little bit later ahead of that speech from Fed Chair Jay Powell. Anne-Marie over at the DNC in Chicago. We'll speak to her in about 5 minutes, so look out for that conversation in just a moment. Let's take an opportunity to get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahira Hackers. Hey, Yahira.
Hi, John. British tech entrepreneur Mike Lynch and Morgan Stanley International Chair Jonathan Bloomer were among the victims found dead on a luxury yacht that sank near Sicily on Monday. Sources who asked not to be identified confirmed Lynch's death, while Bloomer's children said in a statement he and his wife were among those recovered. Lynch was 59. He was attempting to restore his reputation over the ill-fated 2011 sale of his software company, Autonomy, to Hewlett-Packard. Bloomer was 70. He and his wife were guests on the yacht trip celebrating Lynch's acquittal on charges related to Autonomy's sale. Meanwhile, the BOJ is sticking with its hawkish stance as it unwinds years of ultra-easy policy. Speaking earlier today, Bank of Japan Governor Kazuo Ueda said policymakers can add to hikes they made in March and July if the economy and prices are in line with their expectations. As a result, the yen is strengthening against the dollar. And shares of Ross Stores are rising in the pre-market, the discount chain beating Wall Street expectations and raising its 2024 profit outlook as it saw more demand for its discounted apparel, while freight costs also eased. The company's results aligning with other retailers like Walmart and Target, which have shown consumers across the board are searching for bargains. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira in about 30 minutes' time. Up next on this program, heavy on vibes, light on policy.
We will create what I call an opportunity economy where everyone has the chance to compete and a chance to succeed.
We're going to do this, we're going to do that, we're going to do everything, but she didn't do any of it.
We'll talk about why she didn't do any of it up next on the program. That's next. This is Bloomberg. The whole program this morning essentially anticipating the words of one man, Chairman Powell, a little bit later this morning at 10 a.m. Eastern Time. Equity futures on the S&P going into it look a little something like this. We're firmer by 0.5%. It yields just about unchanged on a 10-year, 385.39. The words of Mohammed Al-Erin on this program yesterday. It is problematic in my mind that the market is pricing in so many rate cuts right now. The market is overdoing it. We'll get a range of views on that point throughout this morning. Under surveillance this morning, heavy on vibes, light on policy.
As president, I will bring together labor and workers and small business owners. We will create what I call an opportunity economy where everyone has the chance to compete and a chance to succeed.
The biggest reaction is, why didn't she do the things that she's complaining about? All of these things that she talked about, we're going to do this, we're going to do that, we're going to do everything, but she didn't do any of it.
So here's the latest this morning. Kamala Harris formally accepting the Democratic nomination, prioritizing a fight for America's middle class. Donald Trump zeroing in on immigration as his counter-programming campaign made a stop at the US-Mexico border, threatening large tariffs on countries that don't accept deported migrants. Joining us from the DNC is Chicago is Bloomberg's Anne-Marie. AMH, let's get straight to it. The question that came from the former president, why didn't she do these things that she's complaining about? What's the response from the Democratic Party to that?
Well, Jonathan, she gave this speech last night, which I think you nailed it. It was heavy on vibes and rhetoric and short on policy. That is normal for acceptance speeches. What Donald Trump is going to do now, and when we're on a race 74 days to this election, he is going to want to define her and tether her to Biden. Biden obviously was not polling well, not only because of things like inflation and his age, but also just, other things not happening under the surface. Broader in the economy as well as immigration. So Donald Trump and his campaign has been trying to nail Kamala Harris on those specific policies. Yesterday was really her introducing herself to the American people at the top of the ticket, not just as the VP slot. And when you look at some of the broad parts of policy, whether it's the economy, foreign policy, immigration, and reproductive rights, it really felt like a continuation, or at least she was cherry picking parts of the Biden menu that she would carry through to her administration. Not a lot of details, but broadly in line with what we've been seeing from President Joe Biden. Maybe she spent a little bit more time on reproductive rights, something that she really talked about when she was vice president already and Joe Biden stayed away from. But mostly this felt like a continuation. And Donald Trump is going to try to really tether her to Joe Biden because he polls well when it comes to things like the economy and immigration. And Joe Biden and Kamala Harris did not.
When it comes to Donald Trump, can we talk about one specific policy that's been mentioned in the last 24 hours, threatening large tariffs on countries that don't accept deported migrants? What's been the reaction to that?
Well, Jonathan, when it comes to the Democratic reaction to migration, immigration, Kamala Harris said yesterday this would be her policy position, which is to bring back the bipartisan immigration agreement that was struck between a number of senators, most notably Senator James Lankford of Oklahoma and Connecticut Senator Chris Murphy. And that Democrats have been hammering that the reason why that deal did not go through, because President said, I want that deal killed because I want the issue. So that is their current plan, which is more support for border security, the ability for the president to have his executive power to shut it down. When it comes to tariffs broadly, at the entire DNC, they have been talking about the fact that this is a sales tax. They don't want to say the word tariffs because remember, Jonathan, this administration also kept tariffs from the Trump era under Joe Biden's watch, some of those Chinese tariffs, but they are calling it a sales tax.
MH, appreciate the input. We'll catch up with you in about an hour's time from the DNC in Chicago. Speaking of the menu, BTIG's Isaac Boltanski with this to say. The Harris campaign has treated Bidenomics like a buffet, whereby they can embrace the issues that play well at the kitchen table while hopefully leaving the less politically palatable provisions behind. Isaac joins us now for more. So, Isaac, let's build on that. What's on the menu?
Well, sure. Thus far, it's whatever plays well with the vibes, as you said, right? Like all that we've learned over the past few days is that they have a triangulation play called here to do their best to A, blunt the attacks that Vice President Harris is too liberal, and B, to meaningfully separate Vice President Harris from some of the more contentious Biden issues and to portray her as a change agent. And that's why you saw President Trump just last night trying to tag her as the incumbent. And that's what the next 74 days is going to be about. Is Vice President Harris seen as a representation of the current administration and the incumbency, or is she seen as an agent of change?
Isaac, when you sit down with clients, when you catch up with them in person and over the phone, and they ask you, Isaac, which candidate is the pro-market candidate? Have you formed strong ideas about that yet?
You know, look, I think what we tried to focus on is acute market themes, right? Like we feel pretty strongly that Trump is good for M&A because he's going to change the leadership at the FTC, right? That's something that we can really sink our teeth into. When clients ask who's good for the market broadly, I think that one's a lot tougher because when you look at Trump's policies, we're talking about tariffs. right? We're talking about uncertainty in the global economic regime that I don't think folks are really getting their arms around, especially since we're not going to have the sugar high of tax cuts that come along with that. And so I think that that's really the distinction that we've made. And the point I've tried to make to clients, and the one that I think we really need to start understanding and sinking our teeth into, is no matter who is in the White House, we're going to have buckets and buckets of deficit spending coming through the tax reform effort that comes next year.
Hey, Isaac, in terms of more detail on Harris's policies, do you think that's a when or an if? Do you think she's going to try to go as long as possible without providing detail on that, or is she being sort of strategic about it?
I've been surprised at how open Democrats at the convention have been in their belief and their hope that she will not offer much policy detail. I found it interesting that a number of top Democrats have said, do you remember that Elizabeth Warren, when she ran in 2020, had a white paper for every policy? There were 20 pages, well vetted by academics and market experts for each policy, and she sure as heck didn't win. So why would Harris? And so, look, I think that this is, again, going to be something that they ride the vibes, which John has outlined, for as long as they possibly can. The date that I have circled on my calendar is September 10th. That's the first and only debate between these two. And to me, that's the moment where perhaps the rubber can meet the road in terms of some of these policy specifics that I think we're all yearning for.
Isaac, we couldn't agree more. What is particularly striking to me as well is how much room, how much space progressive like Warren, Alexandria Ocasio-Cortez have given the Vice President, Kamala Harris. They're not tying her to unpopular themes. If you think about where Harris was back in 2019, going into 2020, if you were running in that primary, you had to make commitments to things that weren't going to be popular with the rest of the country. Do they continue to give her that kind of space, Isaac?
I think they do until Election Day. And so there are 2 points to make here. Number one is the one unifying issue for Democrats is that they are against Trump. So as long as they can keep this race about Trump, they will remain together. But the second point, and the one that I think that we should examine over time, is I truly think that if Democrats are in power, you're going to start to see those fissures reemerge. And AMH mentioned the immigration bill that failed. That immigration bill had a chance to become law this year, in large part because of the election. Now, if Democrats win the White House and they're in power in Congress in some way, shape, or form, I'm not sure that same immigration bill passes, because at that point, you see the progressive voices rise and become even louder. And so that's something when we think about that chasm between rhetoric and reality that warrants consideration.
Isaac, when it comes to blue sweep, red sweep, formed any firm ideas on that one also? What's your base case now?
Look, at the moment, I think that we're going through the presidential election. They're the seven on the presidential side. They're the 7 states that matter. I still think that you have to look at the issues that animate those voters. The top ones are the economy and immigration. Trump does better on average by 8 and 15 points in the swing states. As long as that maintains, I view Trump as a slight favorite. On the Senate side, I remain committed to our view, 80+% likelihood that the Senate is going to flip to Republican control. And I think that's something that investors and markets should really moor themselves to, is that we will have a small Republican margin in the Senate that can then give us some sort of framework for thinking about what next year will look like.
Interesting. Isaac, thank you, sir. Appreciate the update. Isaac Bortansky there of BTIG. We caught up with UBS yesterday. I've got the notes in front of me from that conversation. Most of the market negative things that Harris wants, she needs Congress to do. Most of the market negative things that Trump wants, he can do himself. They're my notes, my takeaway from that conversation. That's what it feels like in markets at the moment.
Yeah, I mean, it feels like almost a debate right now of, do you want high taxes or do you want tariffs? And, from an economic perspective, that's the debate. The only caution I would say is, a lot of people are talking about red sweep, blue sweep, but there was a period in Trump's presidency when they controlled both houses of Congress. There was a period in Biden's presidency when he controlled both houses of Congress. In neither case were they able to get the more aggressive things done because the margins were so narrow. So I know the sweep matters, for a lot of political reasons, but policy-wise, they actually weren't able to follow through as much as you might have expected.
And we're expecting some super small margins either way. Stuart's going to stick with us. Coming up on this programme, the latest on the Labour dispute at Canada's 2 largest railways with Bloomberg's Brooks Sutherland. That conversation just around the corner. If you're just joining us, welcome to the programme. Here are your scores. Futures doing OK, up 0.4% on the S&P 500. The bond market pretty stable. The 2-year at about 4%. The 10-year around 3.85. The S&P 500 looking to close out the week just about for a second week of gains on the S&P 500. Yesterday's move, the biggest one-day loss in around about 2 weeks, trimming some of that gain down to about 1/3% on the S&P through the close on Thursday. This Friday morning, we are positive by 0.4% on the S&P 500. On the Nasdaq, up by 0.7. On the Russell, up by 0.4. We've talked a lot about September 6th. Payrolls report just around the corner. Need to talk about Nvidia as well, and we'll do that later. We'll catch up with Mandeep Singh of Bloomberg Intelligence. Nvidia earnings come next week. That's the main event for that Nasdaq 100. Switch up the board and let's turn to the bond market. Yields yesterday much higher, back through 4% off the back of a decent jobless claims number again. We've had back-to-back reads on jobless claims that just contain some of that fear about some kind of imminent breakdown in the US labour market. The 10-year set up at about 385, 30s at 412.30, going into Chairman Powell about 3 hours and 30 minutes away. Let's finish on foreign exchange. 5 weeks of dollar weakness, the longest weekly losing streak for the DXY so far this year. Dollar yen at the moment about 146.11. Dollar yen in focus because of the BOJ and Governor Ueda. I'll get to his comments in just a moment, but essentially the door's still wide open to hike interest rates again at the Bank of Japan. Is that going to happen? How dependent on that is the price action? But we'll get Stuart Kaiser's thoughts in just a moment. Under surveillance this morning, counting down to 10 a.m. Eastern Time, and Fed Chair Jay Powell's remarks at Jackson Hole, Wyoming. Investors looking for clues on the timing, the size and the pace of possible rate cuts. We've already heard from 3 Fed officials in the last 24 hours or so. This came from Boston Fed President Susan Collins. Preserving that healthy labour market while we continue to bring inflation down is what's most important. Stu, we're going to spend some time on this throughout this morning, but I want to go back to August 2022. The speech we had from the chairman, full of pain, a single issue, Federal Reserve. It was about one side of the mandate. It was about inflation. And you just get the sense, the takeaway for me, the obvious takeaway, 2 years later, the balance has shifted to both sides of that mandate.
I think that's 100% right, and I think that started in December. In December, core CPI got down to a level where the Fed didn't want to create an unnecessary recession if they could avoid it. And I think really since December, over the last 6 to 8 months, the Fed has been gradually moving in that direction. We got that one inflation scare around March, and that sort of forced them to be a little more cautious about it. But otherwise, yeah, I think they're of the view right now, I think, that inflation's at a level at which they can kind of risk manage both sides of the dual mandate.
If they were to take stock of things over the last 2 years, I think they'd be pretty pleased. If you think about where we've been, that pain speech, unemployment's around 3.8%, inflation's up there around 8%. They thought to get from 8 down towards 2, you'd have to see that unemployment rate to be a whole lot higher. Unemployment's inched up to about 4.3. CPI's come down from 8 to around 3. That move from 3.8 to 4.3, that move in unemployment, how spooked do you think they will be by that? They sound very calm, but how spooked do you think they'll be by it?
I mean, I think they're concerned by it. They know what the SOM rule is, for instance, and they're gonna be aware of that. I think it's not necessarily the 50 basis points move. I think it's the speed with which it's happened, and I think they're a little bit worried that this is kind of accelerating, not away from them, but accelerating in a way that suggests a sharper slowdown rather than kind of the gradual loosening that they're trying to accomplish. So they're definitely focused on it, but I think it's the rate of change in that rather than the actual change that's occurred that's probably got their attention the most.
We'll see if we get a repeat in early September for the month of August. Your 2-year at the moment, just around 4%, the 10-year at about 385. I want to turn to this story, the latest on the politics. Kamala Harris formally accepting the Democratic nomination for president. Harris capping the DNC by prioritizing a fight for the middle class and arguing she's best positioned to tackle the US economy. Both Harris and Donald Trump will hit the campaign trail for the next 2 weeks out of the first debate on September 10th. We caught up with Isaac Boltanski of BTIG just a moment ago on the politics of all of this. Stu, your conversation with clients, are they there yet? Are they focused on this in a big way yet?
On the election outcomes? Yeah, I think they are. I think in late July, we saw a little bit of election trade kind of, happening. What's been most interesting to me is I was surprised how convinced people got in early July that this was going to be a GOP win. And our view is this is going to be a 50-50 shot, kind of right up to Election Day. And if it's a 50-50 shot, it's very hard to put on high conviction trades this far ahead of time, especially when you have to trade the kind of macro data in the interim. And then you've got this debate in September as well. So, there's a lot of angst about it. I don't know that there's a lot of quote unquote election trades that have been put on, directly. I mean, we're just lucky that we get 2 weeks of campaigning here, to wrap up.
Is that because they don't know? I don't know how lucky we are, but is that because they don't know what those trades should be? If you go back 8 years, I think a lot of people, and I remember being here in New York, a lot of people had formed pretty strong ideas about who was the pro-risk candidate and who wasn't. And they decided that Donald Trump was not the pro-risk candidate. at all. They changed their mind at 4:30 Eastern time on election day morning. Do we have a decent idea this time around?
Scott Cronin on our equity strategy team has said both platforms are bad for equities. I'm maybe not as skeptical about it, but look, I think the Trump platform, at least the deregulatory aspect of it and the lower tax part of it, I think the investment community wants to embrace that combination because it did work the last time around. The tariffs obviously, spooks people a little bit, but there's probably some, risk adjustment going around whether he'll do that and to what degree. On the Harris side, we just really don't have enough data. We're approaching the Harris campaign at this point, basically using the playbook you had for the Biden campaign and sort of transposing that forward, unless and until she kind of gives us a little more data. So, if you had to pick one, I think right now the market is probably, viewing Trump as a little bit more, equity positive. But again, to your point, there's a lot of guesswork going on.
Next debate, September 10th. Look out for that. I think that's the next big stop for this conversation in many ways. I want to turn to the latest from the BOJ. Mentioned it briefly with a movement in dollar yen. Governor Ueda keeping rate hikes from the Bank of Japan firmly in play this year, saying the central bank will raise rates again if the economy stays in line as expected. Ueda also playing down the contribution of the BOJ's July hike to this month's global market rout, citing concerns over the state of the US economy as the key catalyst. I'd love your thoughts on this, Stu. The contribution of the movements in dollar yen to the shakeout we saw at the start of August. Do you think it was overstated?
I do think it was probably a little overstated, but I might also not be smart enough to understand exactly what was happening. But look, if you look at some of those price charts, whether it's yen, whether it's peso, whether it's Aussie, you did have a lot of really large moves in a lot of, sort of higher yielding currencies. And was that directly impactful on equity markets? I'm a little bit circumspect about that. Was there spillover from kind of a volatility shock into equities? And also that it came over the weekend in a low kind of volume market. The VIX got to 60, but that was pre-open. And it was not necessarily very tradable. So, look, I think there was some indirect or residual impact on equities from a flows perspective. And then I think you also had just a broader base value or risk shock that caught people.
We saw how quickly the shorts in the Japanese yen unwound that morning. I think we're all looking at the charts and sort of our jaws were dropping to the floor about how quickly some of this was moving. Do you think we've reset that? Have we just put those trades back on? Where are we now compared to where we were going into that morning?
It's a good question. I saw a lot of headlines about the yen trade has unwound itself, and I'm not really
not convinced
in that camp. No, because this is a trade that I think was accumulated up over multiple years. And to your point, the stuff moved fast, but were you able to kind of unwind 2 to 5 years of positioning in a week? That seems sort of less likely to me. We've had the same conversation on U.S. tech when semis were down 18 to 20%. People said, "Oh, we're back to neutral in tech." No, we're not. This thing built up over 2 years. You didn't fix it in 2 or 3 days. So I do think that positioning risk is still out there. And the same for the VIX. If you look at the VVIX, which is volatility of the VIX, that is still well above 100, and it's another just sort of hint that this positioning story has not totally resolved itself.
You know what stood out for me that morning and the days after that? We heard a lot of economists freaking out. Some economists saying we need maybe an emergency rate cut, 50 like right now. I didn't get that sense from market participants. I didn't sense any real fear at all. What would your takeaway be from that?
The idea of emergency cuts just didn't make any sense to me. I think you would have actually put more risk into the system rather than less by doing an emergency cut, because you would have either A, said, we know something about the data you don't, or B, we think this is a financial system functioning issue that you're not aware of, and we need to cut into that. My view on the economic side of it is, if the market wanted to go down 5% on payrolls, it could have done that Friday. Like, the market was open. Yeah. You had a whole trading day for that to happen. It didn't happen. So clearly something else happened over the weekend, and I think that was much more positioning driven than it was necessarily the market all of a sudden on a Sunday evening trading a hard landing.
Dollar yen right now, 146, just about unchanged. That currency pair is negative by 0.1%. Let's turn to this story. Canada's 2 largest railways preparing to restart after a labour dispute halted work across the country. The Canadian government intervening in an attempt to end the labour dispute. Economists warning the stoppage could cause billions of dollars of losses every single day. Bloomberg's Brooke Sutherland joins us now on this story for more. Brooke, talk to us about what happened and the state of play currently this morning. Where are we?
I think we're a little bit in limbo here. To your point, the Canadian government did step in and is trying to force these railroads and their workers to get back to work. Now, there's a bit of a process here. And we're kind of in limbo until that process resolves itself. But I think the reason why you saw them acting with such urgency is, to your point, to shut down both railroads in Canada at the same time would have massive ripple effects, not just for the Canadian economy, but also for the U.S. It is not all that rare, actually, that the Canadian railroads would have work stoppages for labor disputes, but it is extremely unusual to see both of them shut down at the same time. So historically, shippers have been able to sort of play one off of the other, and now you really do not have that option. And I do have to think that maybe there was some inspiration from what happened with the UAW targeting all of the big three Detroit automakers at the same time to be able to really force their hand to get the benefits and the wage increases that they were looking for.
Brooke, I'm pleased you brought up UAW. On this side of the border, there's a feeling, I think, that maybe we're leaving behind some of these issues as the labour market starts to soften up and weaken just a touch. How did we get here? And can we anticipate more of this kind of labour market action in months and years to come?
I think it would be a mistake to think that we're moving beyond from the power that labor has shown it's willing to use. To your point, we have seen some uptick in unemployment, a little bit of an easing in the labor shortage that the manufacturing industry in particular was complaining about. But I mean, I think when you look at just the impact that shutting down Canada's two biggest railroads would have, that just shows you that the employees that man the supply chain have a lot of power, and they are very willing to use it. You just had the UAW president, Shawn Fain, speaking at the Democratic National Convention, using that opportunity to pressure Stellantis over commitments to a plant that they had committed to keep open as part of those union negotiations. Boeing, meanwhile, is also facing the prospect of a strike, and its workers there had sort of taken the procedural step to move forward with a strike if they can't reach a deal with Boeing before the end of September. And so I think these pressures are still very much alive and well.
But Brooke, for the undereducated, how far apart are the two sides here? I mean, how far are we from getting to something that might be a resolution or even like a temporary, kind of restart?
Sure. So I think the sticking point is actually over quality of life concerns, that the rail workers want to make sure that their needs are met as far as scheduling and rest requirements. And there's a little bit of a balancing act there because the railroads are also concerned about maintaining safety, ensuring that they make sure they have sort of a smooth flowing run of goods. And so that's really where the tension is at this point. And, I do think if the railroads have said that if they're, into forced arbitration, they're ordered to go back to work by the Canada Labor Relations Board, that they will do so. And so it does look like, we're talking about maybe at most days rather than weeks. And, what economists would say is that the longer this goes on, the more painful it is. And so you're really looking at sort of like a week or 2 weeks to see those catastrophic economic effects that we're talking about.
Brooke, we appreciate the update. Thank you. Brooke Sutherland there of Bloomberg on the latest out of Canada. Let's take the opportunity to get you an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hackers.
Hi, John. Shares of Workday are rising in the pre-market, up more than 12%, as the company signals a new focus on boosting profits. It expects it will reach an adjusted operating margin of 30% in the next 3 years. The company, which provides software around HR and other business operations, also announcing a $1 billion share buyback program. Meanwhile, Wall Street is still fuming after the Bureau of Labor Statistics botched its Wednesday release of critical jobs data. Annual jobs revisions were expected at 10 a.m. Eastern, but the data wasn't publicly released on time, causing chaos and confusion across markets. The numbers were finally released around 10:30, but employees at firms like Mizuho and BNP Paribas got a hold of the data earlier by picking up the phone and calling the agency. A BLS spokesperson telling Bloomberg its inspector general will investigate. Wednesday's incident is just the latest BLS mishap. In May, CPI data was mistakenly published 30 minutes early. And Southwest Airlines is looking for customer feedback on potential changes to its free checked bag policy. The company is surveying passengers about hypothetical scenarios involving bag fees for lower cost fares. Bloomberg obtained a copy of the questionnaire, where customers are also asked about their booking preferences and travel habits. Southwest telling Bloomberg the survey doesn't signal an imminent shift, but it does come as the airline is changing its free-for-all seating policy as a result of pressure from activist investor Elliott Management. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. In my experience, and I'm sure in yours as well, when you go to get on a plane these days, they can't get people to check the luggage. It's always the same problem. Isn't that your experience too?
Yeah, 100%.
Shouldn't they start paying us to check the luggage? Never mind giving us for free.
Paying you to check the luggage? Right. That's a...
Give you a cheaper
I like your idea.
Give you a cheaper fare to actually get the luggage on the thing. You see it all the time. All the time. Up next on the programme, showing up late to the game.
I don't think that this committee wants to admit in a way that they were late to the game again. I don't think this is really what they're interested in communicating. They also don't want us talking about a recession.
That conversation up next, live from New York City this morning. Good morning. You're watching Bloomberg TV. Stocks on the S&P 500 just about firmer. We're up by 0.6% on the S&P 500. In the bond market, unchanged on a 10-year, 384.44. Things look calm now. They might not be very calm later. 10 a.m. Eastern Time, Chairman Powell addressing Jackson Hole, addressing the Federal Reserve Symposium, and in many ways addressing global markets. Under surveillance this morning, showing up late to the game.
I don't think that this committee wants to admit in a way that they were late to the game again. I don't think this is really what they're interested in communicating. They also don't want us talking about a recession. Right? They haven't wanted us talking about inflation for 18 months. They certainly don't want us talking about a recession today.
That's the focus of the address a little bit later this morning at 10 a.m. Eastern Time. The 2-year going into that just south of 4% at 399.55. Ian Shepperton of Pantheon Macroeconomics writing the following: I'm never going to be sick of saying this. Monetary policy works with very long lags. They should have eased back in March. Ian joins us now for more. So, Ian, let's turn to that quote. You say they should have gone in March. Let's start there. Why should they have gone in March?
Well, because the softening in the labour market that we're seeing now, with the rising unemployment rate that they didn't expect, is a consequence of the tightening that began back in March 2022. It's 2.5 years ago, which is what I meant by very long lags. And bearing in mind that, the first year of tightening left rates still at a very low level, both in nominal terms and negative in real terms, the real tightening is the story of the last 12 to 18 months, and that probably hasn't yet fully worked through. So as it works through and pushes unemployment above their forecasts and pushes inflation below their forecasts, they need to be anticipating that. And they failed to anticipate, because if they had, they would have cut rates in March.
Ian, what do you think the strongest evidence of that tightening coming into this economy actually is right now? We had Torsten Slock of Apollo saying he's not seen much of a slowdown. What would you point to?
Well, the fact that the unemployment rate is rising steadily. We just had a big downward revision to payrolls in the year through March, and I think it's reasonable to assume that the data since then ultimately will be revised down as well. So effectively, we're at the point now where cyclically sensitive payroll growth, outside the healthcare and education and government sectors, is possibly quite close to zero. And that's not a healthy situation for the economy to be in, with real interest rates north of 2% and going higher, of course, as inflation falls. So they really need to get a move on. I wish they'd started earlier, but I think the case for delaying now any further, waiting for quote unquote more data, I find that deeply unconvincing. They really need to get going.
And Ian, how far do you think they need to cut, or said another way, where do you think neutral is? And how far do they need to get, to get themselves out of this kind of restricted position?
Yeah, I think, my estimate of neutral is a bit higher than theirs. They're at 2.8 for neutral. I think it's probably more like 3.5. But of course, if we're going to suffer, a period of really quite sluggish growth for a while and a rising unemployment rate and inflation potentially heading, I think, next year, maybe even below the target, then you could probably make the argument that they need to be below neutral. Not immediately, but, at some point over the course of 2025. So I think they need to do quite a lot. I think they're probably going to start in September with 25, but I really hope they ramp up the pace to 50s after that, because the rate cuts that they implement now really won't start affecting the economy in any big way until possibly early 2026. But that mindset's a very difficult thing to grasp. Markets tend to think, well, if the Fed raises rates in January, the economy must roll over in February, and it just doesn't work like that. But I think policymakers also suffer a little bit from this fallacy of rapid policy effectiveness. It just doesn't work in that way. So go relatively quickly, go quite aggressively, and bearing in mind that the small business sector is really squealing now. It's under great pressure from tight monetary policy, paying 9% for working capital for small companies now, according to the NFIB survey. So this is a very tight environment. Even if it's not screaming out of the current unemployment rate, the danger is that in 6 months' time, it'll be possibly approaching 5%, which we really don't need.
Ian, these are a list of wants. Now we have to get a list of expectations. What do you actually expect to hear later on this morning?
Well, he's going to tell us they're going to cut in September. I think he's going to push back against the 50. And there's a significant minority opinion in markets that is pushing for the 50. I think he's going to be reluctant to go down that road. By the time we get to the November-December meetings, we'll have a lot more data, a lot more inflation data, a lot more unemployment data. Now, inflation is already on a run rate basis well below what they expected in the June forecast. And the unemployment rate, which they expected to be flat forever, is clearly rising. It's well above what they expected. So they need to change those forecasts. And I think on the back of that, they'll start moving by 50s. So, 4 or 5 25s this year, or in total, so 100, 125 this year, and then more next year. As far as I'm concerned, the more and the faster, the better. But that's maybe because I'm just totally obsessed with policy lags, and I kind of think that the market and the Fed aren't obsessed enough.
And do you think that sort of 25 versus 50, gap is really just driven by labor market data from the Fed's perspective, i.e. they need to be forced to go to 50 by what they're seeing incoming?
Yes, that's right. I think, if the August payroll print is minus 50, say, or even a 0, then I think that first easing in September is much more likely to be 50 basis points. So they're very, very contingent on the latest data. Of course, this doesn't really make a lot of sense. Looking at very short runs of historic data as a basis for driving a policy tool which operates with a lag of 12, 18, 24 months really doesn't make any sense at all. But of course, that's what they did back in the spring when they panicked on the back of those first quarter inflation data, whereas actually what they should have said was that we can ignore them because look at the pipeline. So there's also this question of, in June, they dropped it down to 1 dot for 2024. So then 3 months later to go straight in with a 50 is a huge admission of the error of the June forecasts. I'd like to think that they would be big enough to take the hit and say, actually, we need to do the 50. But I think more realistically, and given Chair Powell's pretty cautious approach to everything, the 25 is more likely. But, if we wake up on that first Friday in September with a terrible payroll number, then, yeah, they'll do the 50 because the market will tell them they have to do at least that.
Yeah, game on. Things change big time then. Ian, from my perspective, I do have a bias. I love the dissent shown at the MPC. Got a lot of people that I know. Tom, TK always says the same thing. Mohammed shares that view as well, Mohammed Al-Arian. The external members of the MPC over at the Bank of England seem to dissent far more often than we see over at the Federal Reserve. How important is unanimity to Chairman Powell? And are you expecting some dissent in any way, shape or form in the next month?
Not if they do 25. I don't think there'd be a formal dissent. I think there's clearly from the minutes there's a really quite substantial support now for the first 25. If he pushes through a 50 against some resistance, let's say he pushes through a 50 and the payroll number isn't minus 50, then I think that would cause some dissent either formally or more likely just in the speeches that you'd see in the weeks after the first move. But I think unanimity, or certainly the impression of a committee moving almost unanimously, is important to them. And it's an important signal for markets as well, though ultimately, sooner or later, if you've got some very reluctant people who are still hanging on, focusing on this backward-looking data and not thinking about the future, then you have to just move past them. And I hope that they would do that.
We've got the whole morning to talk about the Federal Reserve. We get a rare opportunity to talk about some football, Ian, so let's squeeze it in. And a rare opportunity to say the following. Newcastle, top of the league. Ian, expectations for this season?
I think we finish 5th, which would be frustrating because obviously we'd like to finish 4th and get the Champions League spot. But there's some really strong teams there. The emergence of the stronger Chelsea in the latter part of last season, I think, makes it much more difficult for us to get to 4th. But we started okay with a win despite being 10 men for 60 minutes. And I think without European competition this season, we're playing a lot fewer games. Hopefully we'll have a lot fewer injuries than last year's total train wreck disaster. And I think we've got the nucleus of a really great side.
Did you get your season ticket back?
At least 4 other good ones.
Did you get your season ticket back?
No, but my big news is that I've emigrated to France, so it's a bit tricky to get back every other week.
Okay, there we go. Ian, thank you, sir. I'm not sure what I make of the big move, but we can talk about that another day. Ian Shepherdson
another time.
of Pantheon Macroeconomics. Up next on the programme, your lineup looks like this. Bob Dole of Crossmark, Tobin Marcus of Wolf Research, Mandeep Singh of Bloomberg Intelligence, Ryan McKeveny of Zalman, and Stuart Kaiser of Citi. All of that and more still to come from New York. This is Bloomberg.
We're still on the path for a soft landing.
A policy rate closer to 3.5% to 4% is probably where we should be trending.
When we think about rate cuts, we're thinking one a quarter for 8 quarters, not one a meeting.
The Fed, in my opinion, is going to go very slowly.
Bond markets actually are running well ahead of even what the Fed may say coming up to Jackson Hole.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
How much scope is there for disappointment today? This big focus on Chairman Powell's speech in Jackson Hole, Wyoming. This came from Mohamed Al-Erin yesterday on this program. It is problematic in my mind that the market is pricing in so many rate cuts right now. The market is overdoing it. We'll have that conversation this hour. Equity futures right now on the S&P 500 firmer up by 0.6%. On the Nasdaq 100 punchy up by 0.9. On the Russell, the small caps up by 0.6. The only event on the calendar going into the weekend is the most important event, arguably, of the week so far. It is this one right here, 10 a.m. Eastern Time. Chairman Powell from Jackson Hole, Wyoming. How offside are we? How dovish can he be relative to market pricing? This is something that Ian Ligonabimo had to say. It's striking that the outlook has quickly dimmed to the point of once again pricing in more than 100 basis points of cuts by year end in the absence of a tangible breakdown in the labour market. Stuart Kaiser alongside me for the next hour or so. Stu, what do you make of that? How offside do you think things are going into this?
Maybe a touch, but look, again, the market is pricing a range of outcomes. It's not pricing sort of a point estimate, right? So I think the market is probably pricing 50 to 75 basis points of cuts into year end, with the chance that the labor market really comes under pressure and they need to cut more aggressively. So, I mean, I still think the market, frankly, is a little bit in the soft landing camp, but they're seeing payrolls where they are. They're seeing the risk reward deteriorate. So they have to add some risk into what's priced into the forward curve for rate cuts. So
I'm worried about a repeat of August 2nd on September 6th.
Yeah, so in that case, then I can't go into that. I can't go into September with 50 basis points of cuts priced if I'm worried about that. So I think, and this has happened in the past, right? This happened in 2023 as well, when we had a lot of cuts priced into the back half of the year because folks were expecting a recession. Recession didn't materialize, and those cuts got priced out. Did they get priced out, or just did the odds of recession come down enough where your sort of emergency cut pricing, resolved itself?
Remember the story at the start of 2024? We were talking about 6 or 7 rate cuts, and then that quickly disappeared after Q1 inflation data. Here we are sitting here at the end of August with 2-year yields still close to about 4%, 3.99. Your 10-year at the moment down about a basis point. The 10-year maturity trading at about 3.84. In foreign exchange, the euro a little stronger, dollar weaker again. Euro dollar 111.21. Coming up this hour, we'll catch up with Bob Dole of Crossmark ahead of Chairman Powell's remarks. Tobin Marcus of Wolf Research as Harris accepts the Democratic presidential nomination. And Ryan McKeveny of Zalman Associates on the state of the U.S. housing market. We begin with our top story. Stocks rising as traders await Fed Chair Jay Powell's remarks at 10 a.m. Eastern Time. Bob Dole of Crossmark writing the following. The global economic expansion remains intact and will benefit from rate-cutting expectations. Equity valuation remains at risk, especially if growth continues to decelerate and the Fed does not show urgency. Bob joins us now for more. Bob, I want to talk about a gap, a spread, if you will, the difference between Fed funds and the 2-year. You've noted that's the widest going all the way back to 2008. And when people say 2008, Bob, they get worried, concerned. How worried and concerned should they be?
Well, the jury is out. The economy is slowing. I don't think people can dispute that anymore. But we don't know, is it going to be a soft landing or a harder landing? And look, that's, in my view, out of the Fed's control. The Fed, what he does in the next few meetings will impact the economy later. So it's already cooked and we just don't know. So if you want to be fearful, pretend there's going to be a hard landing. Not out of the question. The consumer's slowing. You're seeing it all over the place, but we just don't know how slow they're going to get. That's the problem.
Well, play best guess with me now. Let's take that spread. You've got Fed funds up here and the 2-year down here. How do you expect that to close? Is it the 2-year yield coming up to Fed funds coming down, the two meeting each other? What's that going to look like?
Look, the Fed's going to lower rates. The chairman will make that clear today. But as you and Stuart talked about earlier, we just don't know the pace of that decline. You recollected appropriately, January 1st, we're going to get 6 cuts this year. Oh no, it's going to be 7. Well, here we are, and we haven't seen one yet. And so I think it'll be slow but deliberate, and the language will be, we'll watch very carefully. Look, inflation, remember, is still 2.8. It's not 2. So they have to have their one eye on that corner of the world too, as they, on the other hand, begin to fight this emerging economic slowdown.
Bob, we've rallied into this story. We've noted that the equal weight S&P 500 has printed a couple of all-time highs so far this week. We've seen the leadership come from the small caps at times once again. With that in mind, are we more at risk of this data coming in weaker all over again on September 6th?
I absolutely agree. That's the question mark, and that is the risk, that things slow down faster than the market is expecting. And there's a little bit of, whatever ails us, the Fed will have the cutting power to fight that. Well, what the Fed does today doesn't affect the economy for some time. A little psychology maybe, but that's about it. So it is, how fast does this thing slow?
Bob, along those lines, how sensitive do you think the Fed is to financial conditions here? How reactive would they be if we got, a sharp pullback in equities on some weak labor market data, in your view?
I think you bring up a good point, and that is things that might be out of our control. Look, we had that a month ago. It turned out to be, the Japanese yen carry trade. And, as the market was falling those 3 days, we just had some clues. It was, it's a fear about the economy falling apart that's causing this decline. Well, maybe that's what started it, but we know what aggravated it. So to your point, the financial system doesn't necessarily operate smoothly every day, and we could get a bump there as well. Not predicting that, but there is always discontinuity in the system.
And you mentioned high valuation. Would you have the view that the market kind of needs some rate cuts given the level of valuation here? Or do you think, we can kind of skirt through things if growth stays okay?
I love the way you put it. Valuation is demanding a good environment, maybe a perfect environment. And therefore, the Fed better do exactly what they need to do, and earnings better come along, and we better not have any more consumer weakness. A lot of good news in this market with the PE into the 20s. So yes, we do need to justify these valuations, reasonably good economic news and/or Fed assistance.
What would you advocate for going deeper into the second half then, Bob? I'm just sitting here guessing that you're not telling everyone to sit in cash and take 5% and wait it out. What are you telling them to do?
Exactly. On the other hand, we've got this momentum-driven bull market, and fighting that kind of market is a fool's game. So you got to be invested. Just be careful what you own. You've heard me say it before. Earnings predictability, earnings persistence, and cash flow. So should we get into sort of a bumpy environment, those kinds of stocks will sell off less, but they'll do just fine on the upside.
And Bob, a lot of those stocks you described, I think, are what people have kind of owned, for a period of time here. Is that a steady as she goes, or would you worry about positioning, being so long of those kind of stocks if we did come under some pressure? This is a debate we feel like we're having on tech all the time. Are they safe or not, basically?
Yeah. So I would broaden the list. Valuations got to come into the question relative to the earnings persistence, et cetera, list that I put together there. I wouldn't just own high PE stocks. They have some vulnerability should things not go all that well. And back to what Jonathan said a few minutes ago, the market is broadening. And to those of us who are a little cautious, that's a good sign that we're getting some broadening. I guess it couldn't get much narrower.
Yeah, I think that's the question we get on the broadening theme is, am I willing to broaden out into a weakening economy? And I feel like that's like a big trade-off that people are struggling with. Do you have a view there?
Yes, I do, and that is be careful how much broadening you do. We all know that down cap, small in particular, tends not to do well in economic slowdown environment. They do best when we come out of a recession. And so I think don't be zero in those areas, as many people are, but don't overdo it. I mean, we've lost 2/3 of the small cap rally we saw in July relative to big cap. That's a lot of deterioration, despite the broadening that we're speaking about here together.
Another way of asking the same question, do I want to own financials going into the back end of this year, Bob? Yes or no?
Yes, absolutely. I think that's, look, a lot of lending took place outside the banking system. That's why bank balance sheets are on average, better shape today than they are typically at this point in the economic cycle, and they're pretty cheap. So, yes, I would own financials.
Big bounce off the low from earlier this month. Bob Dole, across Mark. Bob Dole, thank you. A couple of dates we need to think about. Mentioned September 6th a million times. August 28th, NVIDIA. Given where leadership is right now, would you say September 6th is more important than the earnings we get from NVIDIA next week?
Well, one comes first. So, to me, the payrolls number is more important for the overall market. But, I mean, look, NVIDIA is A, a huge stock, B, a big part of performance, and C, you sort of have this feedback loop within large cap tech about stocks buying from one another, CapEx from Google, Microsoft going through to NVIDIA. So the risk you run there is if you were to get a disappointing result from NVIDIA, does that kind of spill out more broadly to that entire cohort?
That stock not immune to some wild moves as well. NVIDIA right now at the pre-market up by 1.4%. The Nasdaq up by something like 0.8%. The S&P at the moment on the S&P 500 futures up by 0.6. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Freight trains in Canada could be running again within days after the government stepped in to resolve a labor dispute that halted work. The intervention is aimed at averting an economic crisis across Canada and the U.S., with commodities like coal, wheat, and lumber all depending on the railways. Both Canadian Pacific and Canadian National, the railways in the middle of the dispute, issued statements saying they were preparing to restart operations. And Alibaba shareholders have approved a plan to upgrade its Hong Kong listing to primary status next week. It's a move that's expected to attract billions of dollars in investment from mainland China. Shares of Alibaba have significantly underperformed those of rival Tencent this year, as China's weak retail sales have hurt Alibaba's key commerce business. Meanwhile, shares of Ross stores are rising in the pre-market, up more than 5%. The discount chain beating Wall Street expectations and raising its 2024 profit outlook as it saw more demand for its discounted apparel, while freight costs also eased. The company's results align with other retailers like Walmart and Target, which have shown consumers across the board are searching for bargains. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes. Let's pick up on that story. Ross stores up by something like 5% in the pre-market. Home Depot, Target, Ross stores, okay. Lowe's, or rather Lowe's Home Depot, and what's happening with Williams of Sonoma, terrible. The likes of Target, Walmart, and the likes of Ross stores, okay. Compare and contrast what's happening there. Is that sort of like home improvement versus consumer staples? What is that?
It does sound like that a little bit. I think some of the comments from Home Depot and Lowe's were that people were sort of, pushing out the decisions to make these bigger expenditures, whereas maybe they're a little more comfortable with the one-off smaller purchase that's, good for your mood for the rest of the day type situation.
Is Ross stores good for your mood?
I don't know if I've ever been in a Ross stores, but so I'm going to say probably yes. They probably have a vibe I'd appreciate.
Good for your mood if you own that stock this morning. Stock's up by a little more than 5%. Up next on the program, Harris making it official.
I promise to be a president for all Americans. You can always trust me to put country above party and self.
That conversation up next. Stocks on the S&P up 0.5%, a little bit of a lift here in equity markets. In the bond market, yields lower by a single basis point, the 10-year 3.84. Under surveillance this morning, Harris making it official.
I promise to be a president for all Americans. You can always trust me to put country above party and self, to hold sacred America's fundamental principles, from the rule of law to free and fair elections, to the peaceful transfer of power.
So here's the latest. Kamala Harris's acceptance speech closing out the last night of the DNC. The vice president pitching herself as the candidate focused on the economy and lowering costs for Americans. Tobin Marcus of Wolf Research noting the following. We read the Harris campaign's approach to policy is driven by strategic ambiguity, in which she will try to broadly signal her values and the issues she will prioritize, aim to connect with swing voters using populist economic rhetoric, but avoid getting pinned down on the details of policies that would be unpopular or problematic to implement. Tobin joins us now alongside Bloomberg's Anne-Marie in Chicago. AMH, over to you.
Good morning, Jonathan. Well, we heard from Harris last night, very heavy on vibes, light on details. This idea, Tobin, thank you for joining us, of strategic ambiguity. At what point does she need to come out and get more into the details on what she stands for in her policies?
So she's going to have to subject herself to some interviewing at some point. Like, she will have to answer questions sooner or later about exactly what she's thinking here. But, you know, frankly, it's a question for voters. And I don't know that policy details are the thing that people are hungering for. The contrast between the candidates is very stark. And as long as people feel like they have a sense of which, you know, what the directional choice is, it may be the case that she can continue kind of floating above some of these debates about.
Will the former president push her to be more detailed oriented on policies? Because he certainly tried to do that last night as well as very early this morning.
Yeah. I mean, he's certainly going to try and pin her down. He also is someone who has a mixed relationship with how much detail one needs to provide on policy, kind of how much you need to spell out your plans. You know, but again, like, they're going to meet in the debates before too long. That'll be a really important moment for the campaigns. But I don't think that the basis on which most voters are going to be assessing that is kind of how, you know, many 14-point white papers did you explain? Like, they're going to be looking for them to go toe-to-toe, sort of show toughness, readiness for leadership. And he's going to be attacking her on her record at least as much as her plans.
You also talk about the fact that she disavowed a lot of policies positions she took running in the primary in 2019. I'm thinking about fracking, Medicare, defunding the police. Right. Who does she lose by those flip-flops? Is it the progressives or is it potentially the centrists that are questioning, why do you keep changing your mind?
Well, if she were going to lose a lot of support from the progressive wing of the party from abandoning those positions, I think this is the week that we would have seen it. And the fact that we had kind of all the big names on the left wing of the Democratic Party out there, you know, cheering, lending their support to hers, shows that they're totally prepared to take her triangulation in stride and live to fight another day. So the question on that, I think, is going to be, you know, when you're talking to swing voters, can you give some plausible account of what happened? Like, do people find it credible for you to say, I just no longer support a fracking ban, oil and gas production are at all-time highs, and not really give much of an account of what happened?
What states could potentially that hurt her in? I'm thinking of Pennsylvania, but where else?
Yeah, I mean, I think fracking in Pennsylvania and, you know, to some extent, potentially sort of Michigan, the rest of the upper Midwest that rely on sort of cheap industrial inputs. Those are the places that you'd probably worry about it the most. By the same token, the shifts on the border are a thing that you'd expect to be problematic across the Sun Belt, you know, those border states of Arizona and Nevada.
Trump was at the border yesterday. He's going to be in Maricopa County today. So is RFK Jr. And there's all this speculation that RFK is going to come out and endorse him. Potentially we'll see that today in Arizona, a swing state, in Maricopa County, a swing district. Right. Could an RFK Jr. endorsement of Trump push Maricopa County, say, to the red column?
Conceivably, you know, but his support has been trending down. So I think it's important to say, I think it clearly helps Trump to have RFK drop out and endorse him. The question is how much it helps him. His support has been trending down. And I think there's a big question about how much of that support can he deliver. Are the 4 or 5% of people who are still supporting RFK, are those RFK voters and loyalists? Or are they just people who don't like the choices that they've been offered and are taking him as sort of a general purpose protest vote release valve? In that latter case, he may not really be able to turn on a dime and say, my voters, here's where you should go now.
Trump is also going to be in Las Vegas before he goes to Glendale, Arizona. He's going to be talking about this idea of tax on tips, which now everyone seems to be for. He's leaning into the economy and immigration, the top two issues. How does she combat him on these top two issues where he polls better?
Yeah, so I mean, on the economy, we've seen her really dramatically narrow the gap in terms of ratings on like trust on the economy. Harris versus Trump looks a lot closer than Biden versus Trump, even if she's still at somewhat of a deficit. I don't know that she needs to get ahead of him. She just needs it not to be kind of a gaping wound the way that it was with Biden. And frankly, this sort of broad message of charting a new way forward rather than going back is an effort to separate herself from Biden just as much as from Trump.
But going back, I mean, she's part of the Biden-Harris ticket, that administration. I want to get this perspective from you. Why do voters not consider her as part of the past 3.5 years?
Yeah, well, so I mean, I don't think it's a settled question yet whether or not they're going to look at her that way. Certainly the Trump campaign is going to try its darndest to characterize her as part of the past. And fascinatingly, we saw a really mixed relationship with the record of the Biden-Harris administration over the course of the past week. When it came to things that they want to present as accomplishments of the administration or signs of Harris's readiness, then they're characterizing her as like she was part of this effort over the course of the past 3 years. When it comes to things like the economy, the bitterness that voters have over inflation, that was the other guy's problem.
It seemed like she cherry-picked what she liked from Biden yesterday in the speech and avoided things that she didn't like. Were you shocked by anything that was omitted?
No, not particularly. I think that they've made basically smart decisions about where to aggressively tack to the center, where to kind of continue proudly defending the positions of the Biden-Harris administration, and then where to try and strike a kind of a populist middle ground as they have in the economy. The question, again, is whether or not voters are going to buy those pivots and that triangulation and sort of accept those as authentic representations of what she would do going forward, rather than some of these positions that she took longer ago.
Last night was very different in terms of the feeling on the convention floor than if it was Joe Biden there. Just a month. It's pretty drastic how quickly this has changed. What does it mean for down ballot races? Yeah, I mean, it's the polling that we've been seeing in Democratic Senate races, for example, has been very, very, very strong, even more so than Harris's. They made a very intentional effort to trot out a bunch of Democratic Senate candidates throughout the week. But it seems pretty clear that sort of unifying the party, generating that enthusiasm, the huge influx of money that she's gotten, I think also helps up and down the ballot because the resources, frankly, are more important at the House and Senate level than they are at the presidential level. So getting these sort of massive boom of fundraising that may eventually also sort of convert into door knocking, organizing, I think that really helps candidates up and down the ballot. Some of the policy proposals we've heard, though, on the economy, she needs a Democratic House and Senate to get through. When you're talking to clients now, what are you suggesting to them on how to look at the composition of Congress?
Yeah, so I mean, I think the House will very likely go the same direction as the presidency. Certainly if she wins, I think the strong expectation should be that Democrats also carry the House. The big question is the Senate in a Harris governance scenario. And I think that despite the polling shifts that we've seen, Republicans are quite strongly favored to take back the Senate. They're definitely flipping West Virginia. I think they're pretty substantially favored in Montana and Ohio. And so in all likelihood, even if Harris wins, she's going to be dealing with divided government.
Does she have strong Republican relationships in the Senate, given the time she spent there?
I mean, I think she has a few at the committee level, folks that she had a strong working relationship with. But, frankly, the things that she was most distinguished for in Congress were fairly adversarial things. Like, I don't think she got a lot of, Republican plaudits for some of the grillings that she did of witnesses and so forth. It was sort of her, viral moments as a senator. I think that she will be leaning in part on other Democratic senators, on folks that she brings into the White House to try and build that connective tissue for negotiations.
Tobin, thank you so much for joining us. Jonathan, that was Tobin Marcus of Wolf Research, joining us really just on 2 hours of sleep, given how late last night went. I love what he says, strategic ambiguity when it comes to policy. And Jonathan, you can expect a lot more of that from the Harris campaign.
Get some sleep. Get some sleep. Anne-Marie, thank you, from the DNC in Chicago. If you missed that quote from Tobin, I want to share it with you all again. This is what it sounds like. We read the Harris campaign's approach to policy is driven by strategic ambiguity, in which she will try to broadly signal her values and the issues she will prioritise, aim to connect with swing voters using populist economic rhetoric, but, and here's the but avoid getting pinned down on the details of policies that would be unpopular or problematic to implement. Here's a takeaway history. The benefit of this candidate not going through a primary again and being tied down to progressive positions that would be unpopular on the national stage. The benefit of that is absolutely massive. I don't think you can overstate it. If she had to repeat some of the things that she was saying back in 2019, can you imagine where these polls would be?
Yeah, no, I agree. Strategic ambiguity is probably the way to go. I think most politicians wish they could be strategically, and have that going on. For investors, it's tricky though, and
much trickier.
You wonder, can I just assume the Biden policy is transformed forward, or do I actually need to adjust to a new reality where the policy base might differ? And to your point earlier, it does make trading the election a little bit trickier than it otherwise would have been.
Super hard. How are they going to govern? We don't really know because they're not really telling us. Coming up on this programme, NVIDIA preparing to report earnings next week. Mandeep Singh of Bloomberg Intelligence will join us ahead of that key event risk on next week's calendar. Equity futures on the S&P 500 positive here by 0.5%. In the bond market, your yield, a 10-year 3.84, a 2-year in at around 4%. That address from Chairman Powell just a few hours away. Hours away from the opening bell. Equities, your scores look like this, up by 0.5% on the S&P 500, up by 0.8 on the Nasdaq 100. The next big stop for this market, of course, is Chairman Powell at 10 a.m. Eastern Time. After that, we've got some earnings from NVIDIA coming up next week. We'll talk about that in just a moment. I wish NVIDIA would report earlier, given their importance to this market, but that's another conversation for another day. Or another conversation for Mandeep Singh of Bloomberg Intelligence, who will join us and try and answer that question for us. In the bond market, your 2-year, 10-year, 30-year shaping up as follows. Your 2-year, 3.9955, a 10-year at 3.8426, 4.1158 on 30s. Yields higher across the curve in yesterday's session following better than expected jobless claims. We've had 3 weeks of pretty subdued jobless claim data, just calming the environment going into this address from Chairman Powell. Let's turn the page and switch up the board and get to foreign exchange. We'll sit on the euro, unchanged at 111.12. Let's talk about the yen, 146. This came from the BOJ governor a little bit earlier on into the session. He said, we are unable, or rather, if we are able to confirm a rising certainty that the economy and prices will stay in line with forecasts, there's no change to our stance, that we'll continue to adjust the degree of easing. That sounded like a man, Stu. I don't know about you. It just sounded like a guy was willing to hike interest rates again over at the BOJ and kind of shrugging off any contribution to the market mess of things earlier this month.
Yeah, I think that's right. Basically saying if things follow our forecast, we're going to keep tightening financial conditions, which is
no problem for stocks over here.
Hopefully not yet. But as we've seen, global central bankers are very sensitive if stocks sell off, so it's okay. Self-correcting.
Do you think that they're sensitive? Are they as sensitive to that story?
They're probably more sensitive to the yen than they are to the Nikkei, if I had to guess. But I think they're probably, to some degree, have to be sensitive to market price action these days.
Dollar yen at about 146, negative on the session by 0.1%. Under surveillance this morning, Boston Fed President Susan Collins and Philadelphia Fed President Patrick Harker both saying in Jackson Hole that it's appropriate to begin lowering interest rates soon, adding that the pace of cutting should be gradual and methodical. Their comments coming ahead of Chairman Powell's speech at 10 a.m. Eastern Time. And Stuart, if you reflect on what we've heard from Harker, Collins, Schmidt yesterday sitting down with Michael McKee, there is no urgency whatsoever at all. And when I hear that, I don't hear these guys drifting towards 50. It sounds a lot like 25.
I think that's right, but they also want to send a message of gradual slowing in the labor market because that's what they're trying to accomplish. And, there's no benefit for them to start getting, very stressed in their commentary, right? It just creates them more problems. So, they have a base case forecast. They're going to try to stay loyal to that, and they're going to try to guide the market to stay loyal to that to keep things copacetic.
Chairman Powell's going to be talking about how effective monetary policy is. That's kind of the title of this month's event. If we were doing this maybe a year ago, would we be talking about monetary policy that wasn't tight enough? How do we know we're sufficiently restrictive? What are we gauging that on? What are we basing it on at the moment?
I think it's a great question. A year ago, if you mentioned earlier, a year ago, the Jackson Hole commentary was very, very aggressively negative, right? And then by December, they were all of a sudden starting about they might need to start easing policy. So as we can see, the posture of these comments can change pretty quick. So let's just focus on the meeting we have before us.
December meeting 23 was strange. We talked about cutting interest rates, and then New York Fed President John Williams comes out the following day and says we're not talking about cutting interest rates. What do you make of the conversation, the communication we've had out of this Federal Reserve recently? Let's just take, for example, the last meeting, end of July, and the daylight seemingly between the chairman and what we saw in the minutes. Do you think the chairman's doing a poor job of reflecting consensus on the committee, or are they just massaging the minutes by such an extent that it kind of looks divorced from what we heard just a few weeks back?
Well, I mean, you asked about dissents earlier. Powell seems to be very intent on not having dissents and is very good at managing that. But once you get out of that room, people are gonna say what they feel, I guess. And I think that's happening. And you could, if you were more Machiavellian about it, you might argue that they're sometimes testing narratives and they want to kind of see how things respond and kind of read and react that way as well. But I think it is a Fed that wants to show unanimity after the issues they had with maybe being too late to start hiking. And unfortunately, people are people and they have their personalities and they get out in the world and they say what they feel.
We're focused on one personality a little bit later. Chairman Powell, 2 hours and about 30 minutes away. Let's turn to the latest from Uber. Uber is planning to start offering self-driving cruise cars to customers next year. The partnership, coming as Cruise, owned by General Motors, has begun trying to regain traction after regrounding its fleet last year following the mishandling of a collision with a pedestrian. Your next story from NVIDIA, preparing to report earnings on Wednesday. Bloomberg Intelligence expecting the chip maker to beat consensus estimates and raise guidance for the third quarter. But concerns about the Blackwell chip delay could weigh on expectations for 2025. We've got Mandeep Singh at Bloomberg Intelligence around a table with us. Mandeep, good morning.
Morning.
Expectations for next week. How high is the bar for NVIDIA this time?
Actually, not that high, but when you look at the history of what they have done in the past 3-4 quarters, there will be at least a $2 billion beat and raise, as they have done. But the magnitude of the beat will get smaller now because their revenue base is much larger. So the data center revenue expectations are $100 billion for this year annually. Now, a $2 billion beat and raise per quarter doesn't seem that high than it did, 4 quarters back when the revenue run rate was half of that. So clearly, I think no matter what they do, the numbers won't look as big as they used to. But I think the tailwind is behind their back. What we have heard from hyperscalers this quarter is they're planning 30 to 40% capex increases going into next year. That's very positive for NVIDIA because it's still 50% of the revenue comes from those 5 hyperscalers.
There's been some discussion about back half of this year because you have the Blackwell rollout that people might kind of wait for that, that chip to get introduced. What do you expect the discussion around that to be?
I mean, look, the market is still supply constrained right now. Whatever chips NVIDIA is making, they get bought because of the supply constraints. And whether it's Blackwell or an earlier version of the chip, right now we are in that phase where every company wants to pilot something with generative AI. And there is the only game in town is NVIDIA. So I don't think there's any problem when it comes to their product dominance or their market share. I mean, we know Intel is struggling. And to me, it's really about 2027. And I hate to say, I'm looking that far ahead, but that's what you have to do because consensus is extrapolating these growth rates 3-4 years out. So if market is assuming they're going to do $100 billion in free cash flow, what is embedded in that? Gross margin of mid 70%. Now, can they keep that going into 2027? Because that's how high the expectations have become. And I think that's where I do think there is some risk because you can't assume a chip company having a recurring revenue run rate the way market is pricing right now. I mean, it's not a software company at the end of the day.
And so where is the supply chain these days? I mean, is the supply chain as long as it was 6 to 12 months ago, or have they started to kind of eat away at it a bit?
So TSMC gives us monthly data points, and what they told us last month was, their revenue grew 45%. So clearly, they are expanding capacity. They're seeing that demand. And a lot of that is helping NVIDIA because no matter how many chips they make, they get sold. So clearly, that's helping. But there will be a point, again, I hate to look at 2027. But that's where you have to look at where there will be equilibrium and where the prices will settle, because right now that supply constraint is what's really driving the NVIDIA growth rate, and it will continue to drive at least for the next few quarters.
I think to some degree, Mandeep, and you've been on top of this story, we need to explore things further downstream. We know where the demand is coming from. We know which companies the demand is coming from. And we need to gauge how much patience investors have with those companies to carry on making the investments they're making without the use case really being demonstrated in a major way. How much patience do you think is left from investors for the big customers out there, the Alphabets of this world?
Yeah, I mean, look, I think this quarter, every company that raised their capex was cheered. Even Meta was cheered when they talked about raising capex. So for now, I think investors are okay because they do see some proof points. But you're right, that is a risk. Whether investors will cheer that for 2026 and beyond. And right now, it's too premature to think these companies will continue to raise 30-40% capex going into 26 and 27 because that hurts their free cash flow. So in the end, All the spend that's going is hurting the free cash flow of these companies, the hyperscalers, and it's translating into NVIDIA's revenue. And
I've heard some people draw some parallels between where we are now and the investments that were made into the cloud business coming out of GFC. Do you see the same parallels? Some of the complaints we're seeing about over-investing in this. And I can sense just from the earnings calls over the last few weeks, over the last few months, that the CEOs themselves are starting to sound a little bit more defensive about the investments they're making. If I pick out Sundar Pichai over at Alphabet, for instance, he had to really come out and very sternly say the biggest risk here is under-investing. Yeah. You want to over-invest, if anything. Are there parallels between where we are currently and where we were 15 years ago?
There absolutely is. And look, this is a super cycle. This is the hottest growth segment right now in tech. And that's why everyone feels it's okay to over-invest, because one of Sundar Pichai's point was also we can allocate these chips for some other kind of workloads. Even if we don't use them for generative AI, we could use it for some other type of processing. So it's not as if, you're over-investing now and if the use case doesn't translate, the chips go waste. You can still keep using the infrastructure for something else. And that's what Mark Zuckerberg highlighted as well. And also the size of the models keeps getting bigger. The question is, how bigger does the next model get? Llama 4 or GPT-5, is it going to be 10 times bigger or is it going to be 2 times bigger? Because if it's 2 times bigger, then probably you don't need as much chip capacity as everyone is expecting. But if it's 10 times bigger, we've got a long runway here. And I think NVIDIA will continue to reap the benefits.
You mentioned TSM. Is this an NVIDIA event or is this an event for semiconductors at large? And will AMD and some of these others kind of be caught up in the story as well?
Right now it feels like the dominant player continues to have that lead, and that's why an AMD or Intel is struggling to catch up. Same thing on the foundry side. TSMC has a clear lead. Everyone else is like a distant second and third. And that will remain. That's the thing with semiconductors is once you establish a lead, you've got a long runway. We saw that with Intel back in the day. And that's what NVIDIA seems to be replicating. The question is, how much transfer is happening from legacy spend to Gen AI? And in this case, NVIDIA seems to be benefiting from the transfer in addition to the incremental dollars because, they grew data center revenue triple digit when hyperscalers weren't spending as much on CapEx. Now they are increasing their CapEx by 30-40%. They weren't in the last 12 months. Still, NVIDIA grew triple digits.
They're a clear and obvious winner. We'll catch up with Mike Wilson of Morgan Stanley in about 30 minutes. Morgan Stanley has drawn a distinction between AI enablers and AI adopters. NVIDIA is the winner of the AI enablers. Of the AI adopters right now, can you identify who's in the lead and who's winning?
Microsoft, by far.
By far. What are they doing that gives them that lead? What have they done?
Just the cloud ramp up, what they did with OpenAI in terms of deploying OpenAI on their cloud, the Copilot revenue they have shown in every earnings, it's growing triple digits for them. And they are in that very early phase. Think of NVIDIA, 6 quarters back. That's where Microsoft is with their Copilot ramp up. And that's where I think they have a clear winner's strategy.
Apple likes to be late and better. Do you think they can be late and better?
I think the fact that they don't have their own large language model, that's what gives me a pause. Apple's strategy is, yes, we have the distribution. We'll use everyone's large language model and deploy it on our phones. But not owning the IP is what Apple has traditionally done well is they vertically integrated. They own their chips.
Yep.
They owned everything in the phone. So not owning the large language model, to me, that's a concern. But clearly, they have demonstrated that they can come back and show a winning strategy.
Apple up by 0.7%. Mandeep's going to be on TV a lot next week. Looking ahead to those NVIDIA earnings. Mandeep, good to see you. Thank you, sir. Mandeep Singh there of Bloomberg Intelligence. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Johara Hackers.
Hi, John. The BOJ is sticking with its hawkish stances as it unwinds years of ultra-easy policy. Speaking earlier today, Bank of Japan Governor Kazuo Ueda said policymakers can add to hikes they made in March and July if the economy and prices are in line with their expectations. As a result, you're seeing the yen strengthen against the dollar. Meanwhile, former President Donald Trump is threatening large tariffs on countries that don't accept deported migrants. Immigration remains a cornerstone of Trump's re-election pitch, while imposing large tariffs on both adversaries and allies is also a key part of his economic policy. Trump visited the U.S.-Mexico border yesterday as he intensified his attacks on Vice President Kamala Harris and her handling of illegal immigration, all part of his effort to reclaim Arizona. And in the latest twist in the Paramount saga, Skydance Media is accusing Paramount of breaching the terms of its deal by continuing to engage with another suitor. Skydance says Paramount didn't provide written notice of the extension of the so-called Go Shop period and says the extension isn't valid because Edgar Bronfman Jr.'s proposal isn't superior to the Skydance Media offer. That's your Bloomberg Brief. John?
Yeah, Harry, thank you. I know it shouldn't be this way, but there are certain stories that just give you a headache. And that's one of them. And I'm just trying not to talk about it. You following this story? This drama? You avoiding it?
I'm avoiding it, and you should never date two people, Jonathan. That's really the takeaway.
There we go. Great advice from Stuart Kaiser. Okay, for those that need it. Up next on the program, the frozen housing market.
Even if rates were to stay at current levels, at some point, folks are going to adjust and the transactions are going to pick up. And we need that to happen. The existing home market is essentially dysfunctional at this point. It's frozen.
Unlocking that frozen market up next. This just came from Michael Harnett of Bank of America. Weaker Main Street, fragile Wall Street, slowing China, all of that equals treasuries are the best hedge for Q4. Priya Misra, JP Morgan, coming up a little bit later. Priya's going to have some thoughts on that. Your bond market at the moment going into Chairman Powell, 384.63 on 10s. In the equity market, just elevated a lift here, up 0.5%. Crude participating, a rally there, up by 1.8%. WTI 74.32. Under surveillance this morning, unlocking a frozen housing market.
Even if rates were to stay at current levels, at some point, folks are going to adjust and the transactions are going to pick up. And we need that to happen. The existing home market is essentially dysfunctional at this point. It's frozen. We're at under 4 million units. That should be closer to 5.5 million units. And remember, at the other end of an existing home sale, there's typically a home purchase, and that could be a new home purchase. So it's not a zero-sum game here.
Here's the latest on this front. US mortgage rates dropping to a new low this year as potential home buyers await Fed rate cuts. The latest data showing small but still weak existing home sale gains ahead of new home sales coming out later this morning. Ryan McKeveny of Zelman and Associates saying this: the market is currently chopping along with the bottom at some of the weakest existing home sales levels since the great financial crisis. But we expect to see improvement later this year and more so in 25-26. Ryan is with us now for more. Ryan, can we talk about what is funding the purchases that we see at the moment? Can we start there? Do you have any stats on the amount of cash buyers in this market at the moment? Because earlier this week, mortgage applications dropped off a cliff. How much of this is just very wealthy people with access to a lot of cash?
Hey, John, thanks so much for having me. That's definitely a component of things. The latest data suggests coming up on 30% of all transactions are cash buyers. It's up from a year ago. It's actually at the highest level since 2014. So you led into this with the overall weakness in existing home sales, which is true. But there is a bit of a dichotomy where the high end of the market, sales occurring above $1 million, and that cash buyer who has the ability to forego a mortgage with a high mortgage rate, they're active in the market. And the people who are being pinched, unfortunately, are that lower end consumer who's really struggling with affordability.
So, Ryan, do you think there are big cyclical signals right now in the housing market, or are these just sort of permanent structural issues of the last several years?
I would say it's mostly cyclical. The impact of rates tends to be the biggest factor, again, to that affordability dynamic, the home buyer who's attempting to leave a rental to get into home ownership. Payments have gone up very meaningfully. It's not just that interest rates are 2x what they were a few years ago. Home prices have gone up very meaningfully. So I would say the cyclical aspect of things really ties to mortgage rates. The good news with that is we have seen some reprieve more recently. We're now around 6.5% on a 30-year fixed mortgage, down from close to 7% just 2 months ago. So moving in the right direction. I think to the extent we continue to see improvement in mortgage rates, you can expect some cyclical improvement in the housing market and home sales.
Brian, what are you seeing from lenders in terms of maybe innovation and different ways of kind of packaging up the product to get people involved? I think I heard, folks were embedding free refis in some of the mortgages. What are you seeing on that side of things?
Yeah, that has been a play of some of the lenders. Hey, buy with us now. We know it's a high rate, but we'll cut the cost of a refi when rates move lower. That has been happening. There's also been some programs, lower down payment requirements for certain buyers. Now, there are challenges with those because oftentimes the subset of buyers that are able to qualify might be in a price point or might be at an income level where it's still very aspirational. They're still not at that point to be able to get into the home and afford the monthly payment. So there is some innovation. I would say it's more on the margin. But yes, there are lenders attempting to help solve the affordability problem to the extent they can. The other side of the coin with that, where there has been a meaningful change, home builders in terms of new home sales have been offering mortgage rate buydowns. I wouldn't necessarily call that an innovative product, but it has definitely moved the needle, and there's been a lot of share gains in the new home market compared to the existing home market because those builders can buy down that mortgage rate, make it more affordable for their consumer.
Ryan, as you know, the focus on Wall Street for markets worldwide today is on a speech from the Federal Reserve Chairman at 10 a.m. Eastern Time. There's a big focus on whether he cuts it by 25 basis points in September or by 50. I think we'd love to gauge from you, just to get a decent idea of what difference 25 or 50 would actually make. And if we can spend a little bit more time on the lock-in effect that we're seeing at the moment in the housing market. As you know well, our audience has followed this as well. The effective mortgage rate, so the average rate right now for outstanding mortgages is something like 4%. And as you mentioned, the market rate is a little south of 7%. So we've got a big spread and no real incentive for people to sell a home, particularly for those that have got a two-handle on their mortgage. How much does that spread, Ryan, need to close? How many rate cuts do we need from the Federal Reserve? What would actually change that lock-in effect, that lock-in story, and get some inventory back in the market?
Yeah, it's a great question, John. A couple components to that. So in terms of the Fed actually cutting, a lot of that seems to be priced into the bond market already. So all else equal, we do think the Fed starting to cut is a positive for mortgage rates, but we think it's a modest positive. It seems to indicate to us that the 10-year Treasury yield unlikely to change very much, or at least that's what the bond market is telling us. The spread between short-term and long-term rates could compress. Generally, compression in that spread is beneficial, or let's call it a de-inversion and then steepening of the yield curve tends to be beneficial for mortgage spreads. Where we are today, if we think about a 30-year fixed mortgage against the 10-year Treasury yield, today it's about a 260 basis point differential. Long-term average, that's 170. So we're close to 100 basis points wider than normal on that mortgage spread. So as the Fed does begin cutting, and again, whether it's 25, 50, or how quickly this goes is anyone's guess. But we would expect that mortgage spread to slowly compress, and that's where we think the benefit to mortgage rates comes, as opposed to banking on some big change in the 10-year Treasury yield, for example.
Got it. So this is the $1 trillion question, if I can follow up, Ryan, and then you can follow on. I want to understand what it does to prices. Everyone does. Is this going to stimulate supply more than it does demand, or demand more than it does supply? And what do prices do?
Yeah, and that ties in greatly with your last question on the lock-in effect. What I would say is in 2024, even as rates have stayed high, mortgage rates have stayed high, you have seen the lock-in effect start to lessen. The number of new listings coming to market is up from a year ago. The amount of inventory on the market is currently up about 20% nationally. There's markets where it's up 50, 70, 90%. So even with high rates, you've started to see the lock-in effect ease. As rates move lower, more supply probably does come to market. It also does unlock demand. So we're in a bit of a tricky period. Our view is home prices do continue to move higher, but the rate of growth is below average going forward. So we've been in a period where home prices went up 15 to 20% back-to-back years in the beginning of COVID. Last year, they were up about 6%. That's above average. Typically, they're up 4% in a given year. We think home prices are probably going to rise about 2%, 2 to 3% the next couple of years. So it will be a combination of both supply coming back to the market, but also certainly some unlock of demand if we do have lower mortgage rates.
Awesome. Ryan, thank you, sir. Ryan McKeveny there of Zelman and Associates. Got to do this again soon. Stuart, it's a big question, I think, for the Federal Reserve as well. Is this inflationary or disinflationary if they start cutting interest rates?
I mean, their view, I guess, is it's inflationary, right? I mean, if they believe high rates gets inflation down, then you have to believe, low rates gets inflation up.
Housing market's been an odd beast, though, right?
It has. It's a unique thing just because we have those longer dated fixed rate mortgages. If you talk to investors in Europe or Australia or other parts of the world, the higher rates have actually really eaten into demand for other goods as well, in a way that because we have that low effective mortgage rate locked in, it just hasn't affected the U.S. the same way.
UK mortgage market is a very, very different beast. Stuart, this was fun. 2 hours flies by.
It does. Thanks for having me.
Good to see you, sir. Thank you. Stuart Kaiser there of Citi. Coming up on this programme, we'll catch up with Priya Misra of JP Morgan Asset Management, Mike Wilson of Morgan Stanley, Sarah House of Wells Fargo. That's your lineup for the third hour of Bloomberg Surveillance. Going into a big address from Chairman Powell at the Jackson Hole get-together in Jackson Hole, Wyoming. We'll catch up with Lisa Abramowitz and TK in about an hour from now as well to get you a preview of that address. From the big man at the top of the FOMC, we've heard from 3 officials already, and there is no real sign of urgency to reduce interest rates. You just get the sense over the last few weeks this is a committee getting closer to an interest rate cut in September, but the conversation on Wall Street has gone beyond that. It's talking about 100 basis points of cuts for 2024 and maybe even 50 on September 18th. The calendar, before we get to September 18th, we've got payrolls on the 6th, CPI on the 11th. So a lot of work to do between now and then. The next hour of Bloomberg Surveillance, up next.
We're still on the path for a soft landing.
A policy rate closer to 3.5% to 4% is probably where we should be trending.
When we think about rate cuts, we're thinking 1 a quarter for 8 quarters, not 1 a meeting.
The Fed, in my opinion, is going to go very slowly.
Bond markets actually are running well ahead of even what the Fed may say coming up to Jackson Hole.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
So let's go back to Chairman Powell, August 22nd, 2022. And we're sitting there and I've got Lisa and TK either side of me, and we throw over to the chairman for his speech. We're thinking it's going to go about 20 minutes. It lasts 8 minutes. And there's one big takeaway. It's one word. The word is pain. And the quote, the big takeaway that we repeated for the next 12 months went like this. While higher interest rates, slower growth and a softer labour market conditions will bring down inflation, they will also bring some pain to households and businesses. The chairman went on to say, these are the unfortunate costs of reducing inflation, but a failure to restore price stability would mean far greater pain. Again, pain. Think about where we were 2 years ago. CPI running at about 8%, unemployment running about 3.8%. This Federal Reserve, this central bank, was a single issue central bank. In that moment, it felt like it was a single mandate central bank. 2 years later, this is how things have changed. CPI's come down from about 8 to around 3. Unemployment's gone from about 3.8 to 4.3. And that change means this view from this central bank is more balanced. It's a dual mandate, full employment with a price target of about 2%. And it's that balance that a lot of people anticipate from the Fed chairman when he speaks in about 2 hours' time. Going into that address, your scores look like this on the equity market from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now. Equity futures up by 0.6% on the S&P. On the Nasdaq 100 up by 0.8. The Russell, the small caps doing okay, up 0.5%. Your main event from Jackson Hole, Wyoming, just 2 hours away. The Federal Reserve Chairman addressing the annual get-together for the Federal Reserve, but in many ways addressing markets worldwide. 10 a.m. Eastern, 3 p.m. in London, 10 p.m. in Hong Kong. Talked a little bit about the price action. I want to turn to the bond market as well. The cross-asset check, the 10-year 385, a 2-year a little north of 4 after jobless claims came in okay yesterday for a third consecutive week. In the FX market, a euro about 111.20, but the dollar weakness has been a key theme in this market for much of the last month. Your lineup for the next 60 minutes or so. Coming up, we'll catch up with Priya Misra of JP Morgan Asset Management as investors prepare for Fed Chair Jay Powell's comments from Jackson Hole. We'll speak to Mike Wilson of Morgan Stanley on a data-dependent equity market and Sarah House of Wells Fargo on the risk shifting to labour. We begin with the big issue. Traders placing their bets ahead of Fed Chair Jay Powell's comments from Jackson Hole at 10 a.m. Eastern Time. Bloomberg's Mike McKee is on the ground for more. Good morning, Mike. What are you looking for?
Well, we're not looking for 8 minutes, that's for sure, John. We're looking for a kind of standard speech from the Fed chair that doesn't really break a lot of new ground. I think he's probably just going to essentially repeat what he's been saying for some time now, that we are seeing progress on inflation. It's enough to give us some confidence that inflation will get back to our 2% target so we can soon begin to adjust interest rates. Now, I don't think either that he is going to give us any kind of magnitude for that adjustment because they still have some data coming in September. If it comes in as expected, probably 25 basis points, but they leave their options open for 50 if we got some bad numbers on especially the labor market.
Mike, do you sense that this Federal Reserve and this market, as is typically the case, are in very different places? We've heard from a few officials in the last 24 hours, from Harker, from Collins. You spoke to Schmidt of Kansas City. They didn't give me the impression there was any real urgency to reduce interest rates.
No, there's not a feeling here that needs to be sort of an emergency priority. The feeling is that the economy is strong and could withstand interest rates staying where they are. They may not be appropriate for where we are, but as inflation goes down, real rates go up. So they have to move at some point, but they don't need to do it in a sort of intermeeting emergency way. There is a sort of feeling that they have gotten a soft landing, although they won't use that term, but that unemployment is still low, even though it's gone up. Inflation is falling, and growth is still strong, stronger than they expected. Now, when you look at futures, I think you get a lot of people who are betting just in case, maybe hedging the idea of a 50 basis point cut. But the Fed officials I've talked to don't think the markets are necessarily way out of line right now, the equity markets or the bond market.
TK, quick question, or rather, Mike, quick question. Did TK make it out of bed? That's what we all want to know. Has he made it to the set?
He did. He is drinking coffee behind me, so he will be here.
All right.
Along with the mountains, they'll show up too.
You tell him to behave. Mike McKee, thank you, sir. Waiting for TK and Bramo. In about 40 minutes' time, they're going to join this programme. Sun's going to come up. It's a beautiful view. If you've ever been, it's absolutely wonderful. Look out for that in about 40 minutes' time. Priya Misra of JP Morgan Asset Management joining us for the hour on this programme. Priya writing the following. I will be watching closely if Powell provides context around cuts. Is the Fed cutting due to the normalisation of inflation, or is there an element of risk management due to the slowing labour market? Any mention of the latter will keep the possibility of a 50 basis point cut alive. Priya joins us for more. Priya, it's good to see you.
Thanks for having me.
Thanks for being here. So Mohamed El-Erian was on the programme yesterday. He said maybe this rate market is overdoing it a little bit. You actually don't think 100 basis points of cuts is overdoing it. Can you walk us through your framework for thinking about current market pricing and whether the Fed chairman will validate some of that a little bit later this morning?
Sure. So, the market ultimately prices in essentially a distribution of outcomes. So if we stay in a soft landing, I think then they're really going 75 basis points. So you might argue that the market might be overdoing it. But what if growth, the slowdown that we've seen, I think there's no question that growth is slowing, the labor market's slowing. If we slow below trend, then the Fed's telling you, we don't have to actually read between the lines. They're telling us if the economy slows down more, we're going to cut faster, we're going to cut more. So the market's essentially pricing in, I would say, 20% chance of a recession. So as they price in all these outcomes, I think 100 basis points is risk management from the market. Now, does the Fed tell us that they're in risk management mode? I think there's some elements of that you can sort of see in the minutes. We always have to think about what do we hope the Fed tells us? What will Chair Powell actually tell us? I hope he talks about risk management because, what is Jackson Hole about? It's about transmission and effectiveness of monetary policy. That's the topic. The one thing we've learned through the hiking cycle was those lags are long, variable. Effectiveness is unclear. There's all these supply issues that might have helped inflation. That immaculate disinflation that we've had, well, they have to protect that. And as they start thinking about risk management, that's where I think that 100 is doable. Also, they're talking about this gradual pace. Over time, I get it. But maybe policy is extremely restrictive. Maybe they should cut a little more aggressively initially, get to some level of neutral, and then finesse it. I don't know if we're going to hear that, but I think that's what the market's really hoping to hear.
Yeah, as you mentioned, sometimes there's a massive spread between what we want and what they actually deliver. You said they're extremely restrictive. Can we just sit on that for a moment? What are you looking at that tells you that those lags are really actually starting to bite into this economy? Where in the data set, where from the corporate communication, what stands out for you?
Sure. So I think it's across the board. You're seeing inflation come down. You're seeing the unemployment rate go up. Now, the big debate has been, is it all supply-led? And I think there's some aspects of supply, absolutely. Supply chains have improved. There's been significant immigration boost to the labor supply. But when I look at, job hiring intentions, you look at JOLTS, you look at the quits rate, that started to come down. There are elements that the labor market is slowing. Now, I think the debate for the market is, are we slowing to trend or a little below trend? That's the soft landing. Do we continue to slow? And we know monetary policy works with a lag. I think the issue with a lot of macro people like me is we look at aggregate data, and the aggregate data has been okay. You start looking, but I would say the economy is extremely bifurcated. You start looking at low-income consumers. I would even argue middle-income consumers. They're essentially trading down. You start to look at small businesses. There's some element of slowdown. So it's made me not restrictive in aggregate. It's absolutely restrictive. Look at the housing market. You were talking about how it's frozen. I think it's restrictive there. We're going to need a lot of cuts for the housing market to unfreeze. I don't think 50 or 25 is going to do it. You're going to need 200, 300 basis points.
I've sat here, my head spinning, not because of this conversation, just the conversations over the last month or so, and I'm sure your head's been spinning too. 3 weeks ago it was growth scare. They need to cut quickly. And there were some economists, some respected economists, coming out and saying they need to go 50 immediately. 3 weeks later, everything's changed. If I go back to the start of July, Chairman Powell was in Sintra, Portugal at the ECB's get-together, and he pointed to the strength of the market as a reason to have patience. The strength of the labour market gave them time to get this right. The comments that he delivered in early July, can he deliver later on this morning? Can he point to labour market strength and tell everybody that he's got time and that's a reason to be patient to get this right?
So I'm glad you bring up Sintra. And the Fed is saying they're not data point dependent. So you could actually argue that, no, he shouldn't change his view. But here's what I struggled with that Sintra message. They told us, Chair Powell told us, that the labor market is back to where we were in 2019. And they just needed a little bit more confidence on inflation. Look at where monetary policy is in 2019 versus today. Real rates, about 150 basis points higher. Nominal rates, Fed funds was 175, it's 5.5. So I struggled when I heard Chair Powell at Sintra. I said, why is the market not pricing in very quick cuts? Why isn't the Fed cutting rates fast? Now, they're never going to cut 200 in a go. But I think this is the argument of start early, maybe start a little aggressively. I can see them go 50. What's the bar for 50? I don't know if we're going to hear it because we do have a lot of data between now and that September meeting. But is the bar that high when, policy is that restrictive?
We need to talk about the price of the story in the bond market as well. There's a lot of Fed talk. Let's get to the price in the bond market. This came from SocGen. I'll share this quote with you. They say the short-term rates market is pricing in an imminent recession with 125 basis points or so of cuts by January. We expect a more gradual cutting cycle as the risks of the Fed remain balanced between inflation and employment. Kind of conversation you and I are having right now. They go on to say this about Treasuries, Priya. Treasury bonds performed admirably as portfolio diversifiers during the recent sell-off in equities. However, we see limited room for sustained rallies from here. What would you say to that?
I don't agree. I think in a soft landing, yes, the 10-year should probably be 3.5, 3.25, something in that. Because where does the Fed end up? Probably close to 3% in a soft landing. What happens in a hard landing? What happens if the economy does slow down? These lags take a while. So at that point, the Fed's going to cut into accommodative territory. That's 2%. So I would argue the hedging property of treasuries, it's worked. It's going to continue to work. If risk assets struggle, the only game in town is going to be treasuries because the Fed's going to be cutting then aggressively. You're going to be hearing 50, dare we say 75? I mean, they hiked in 75 increments. They can absolutely cut aggressively. They can cut too. I think, beyond the 25, 50, let's look at the end point. So I struggled with the market pricing in the argument that the market's pricing in a high chance of a recession. Where's the end point? It's little above 3%. We can argue maybe our star is not 0 and maybe neutral rate is not 2.5, it's 3, 3.25. Well, we're pricing that in. We're not pricing in accommodative policy. When the market starts pricing in 2% endpoint, then I'll tell you recessions in the market. We're not there. We're pretty far from there.
Priya Misra of JP Morgan is going to be sticking with us. Your 2-year around 4%, the 10-year at the moment about 3.85. Let's get you some stories elsewhere with your Bloomberg Brief. Here's Yohara Hackers.
Hi, John. Vice President Kamala Harris formally accepted the Democratic nomination Thursday night. Harris vowing in her acceptance speech to prioritize a fight for the middle class and reproductive rights, capping this week's Democratic National Convention. The Democratic Party is looking to seize on recent momentum created after President Joe Biden dropped out of the race, an unprecedented move in modern U.S. politics. Meanwhile, Wall Street is still fuming after the Bureau of Labor Statistics botched its Wednesday release of critical jobs data. Annual jobs revisions were expected at 10 a.m. Eastern, but the data wasn't publicly released on time, causing chaos and confusion across markets. The numbers were finally released around 10:30 a.m., but employees of firms like Mizuho and BNP Paribas got a hold of the data earlier by picking up the phone and calling the agency. A BLS spokesperson telling Bloomberg their inspector general will investigate, but Wednesday's incident is just the latest BLS mishap. In May, CPI data was inadvertently published 30 minutes early. And Southwest Airlines is looking for customer feedback on potential changes to its free checked bag policy. The company is surveying passengers about hypothetical scenarios involving bag fees for lower cost fares. Bloomberg obtained a copy of the questionnaire where customers are also asked about their booking preferences and travel habits. Southwest telling Bloomberg the survey doesn't signal an imminent shift, but it does come as the airline is changing its free-for-all seating policy, but that's as a result of pressure from activist investor Elliott Management. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the morning calls, plus Mike Wilson of Morgan Stanley on the equity market, going into that address from Fed Chair Jay Powell a few hours away. From New York City this morning, good morning. The opening bell 1 hour and about 14 minutes away. Equity futures on the S&P 500 up by 0.5%. Yields just about unchanged. Things are steady, 384.44. Let's get you some morning calls. First up, Guggenheim upgrading Roku to buy. The analyst saying the company is closing the gap between platform engagement and advertising sales growth. The stock is up by 4.7%. Your second call from RBC lowering its price target on Williams-Sonoma to 147. The analyst adopting a more cautious top-line outlook, saying margin upside feels pretty limited. The stock is still higher by 1.5% this morning after a pretty difficult day in yesterday's session. And finally, Wedbush raising its price target on Nvidia to 138 from 120. Analyst Dan Ives saying next week will be, quote, and his quote, the most important week for the stock market this year and potentially in years. Don't know if you think that's hyperbolic, but that's Dan Ives for you. As Nvidia prepares to report earnings on Wednesday, that stock is up by 1.3%. Mike Wilson of Morgan Stanley joins us ahead of the most important earnings print in years. I'm not sure, Mike, if you'd agree with that. I will ask you this, though. What is more important, Mike, for you? This address from Chairman Powell a little bit later this morning, or that payrolls print on September 6th?
Yeah, good morning, John. I think in my mind, it's about the payroll number. It's really about the labor data, period. That's what's going to dictate what the Fed does. They've said that, and that's what the market's going to trade off of. I mean, if you go back a month ago, that's when we had this correction, and it really did kick off with a weaker non-farm payroll number. Now that has been somewhat refuted by better claims, and also just the deal that jobs are okay still. But then we got the revision, so the data is still very mixed in my view, and the market under the surface, as we like to look at it, is still trading very defensively. It doesn't know. So I think it comes down to that payroll number. The Fed will react, and we'll see. And we'll see how the market goes. I mean, my general view is if they cut 25, that's probably fine. If they cut 50, historically, that has been a bad signal for the equity markets.
Mike, you say the market's traded pretty defensively. I want to pick up on that, just build on it a little bit. In some places, we've started to see that breadth improve again. Small caps have started to perform. We've seen the record highs on the equal weight through this week so far. Mike, do you think we're just as vulnerable as we were at the start of the month to weak data, or if we reset things differently this time around?
I think we're more vulnerable to another negative data point on the labor market. That was sort of a warning sign. And once again, we don't know the result, but if we get a negative payroll number, I think the market could react just as bad at the index level. So let's talk about that under the surface. I mean, you mentioned small caps have done better. Well, they did better in July when the money rotated away from the Magnificent Seven and some of the quality growth leaders, and it went into defensives, quite frankly. So defensives have now, and when I say defensives, I mean utilities, healthcare, staples, and real estate. Those four sectors have led on a 5-day basis, on a 1-month basis, and a 3-month basis. So it's been very consistent. And that's about the time we pivoted back in May to a more defensive book. And I don't really see any reason to kind of deviate from that. Now, if we get a very strong payroll number, then that trade is going to reverse sharply back to the more cyclical parts of the market. I think it's going to be very messy. I don't anticipate the labor data to improve dramatically. I don't know if it's going to deteriorate further. But given the signal from the stock market and the bond market, quite frankly, the markets are definitely paying attention to this, and this is a big number.
Mike, if I can ask, what probability of a recession do you think the equity market's essentially pricing in? And you can look at breadth there, or you can look at aggregate. And the other question was on margins. How do you see that evolving? Because I felt margins had a nice tailwind with the fact that essentially cost of input prices were coming down. Does that change? If prices are going to be more stable, it's all going to come down to those sales numbers. So I guess two questions.
Yeah, we'll start with the second one. I mean, I think you're dead right on. I mean, what the micro data has been definitely weaker than the macro data. And let me just take a minute on this. This kind of goes to my core thesis that we basically have a policy mix, call it fiscal dominance, where fiscal policy has been really the dominant lever for the last couple of years. That's what led to the inflation breakout, in my view. There were some supply constraints, sure, but basically we had too much aggregate demand from fiscal stimulus. And now that has somewhat prevented the Fed from being more proactive with rate policy. And in effect, it's crowded out, as you were mentioning earlier, it's crowded out the middle class, it's crowded out the lower class, lower income class for sure. And even some of the wealthier investors now are being crowded out. And that's why small caps have underperformed so much. So that's very much intact. And I think that that policy mix has been unusual. It has also extended, I think, the cycle longer than what it probably would have been, which has kept the Fed doing their job of keeping rates higher for longer. And now it's working. Now it's really starting to bite in the interest rate sensitive parts of the market, like housing, autos, and some of those areas. So overall, I would say that at the S&P level, it's not really pricing in a recession at all. I would say at the stock level, it's probably similar to where the bond market is. That's why we have defensive leadership. That's why small caps have been persistently underperforming. And it's probably in the 20% range or so. And that's what always happens, right? Until it's definitive, the stock market doesn't really want to go there, and it won't go there because it needs the hard data.
Thank you, which actually makes a lot of sense to me. We all see the same data. So this idea that the bond market might be pricing is something very different from the equity market. I mean, we're all looking at the data. We're all listening to the Fed. One point you made earlier, that 50 basis points might be viewed negatively. And I see the point. What does the Fed know that we don't know? Why are they cutting 50? But if we hear from Chair Powell, and I don't know if we'll hear it today, but providing a context around potentially going faster initially, that if monetary policy is restrictive, they're just trying to reduce the level of restrictiveness. You think the equity market might like it, that they can be a little more aggressive initially so they're not behind the curve? I guess that was the learning from the hiking cycle. It would be to start earlier so you don't have to do as much. You think he can finesse that message and keep it in the normalization of 50 basis point cut?
Well, anything's possible for sure. I'm just saying, historically speaking, when the Fed is kicked off with a 50 basis point cut, it usually has led to, not a great outcome. That basically we're on the downswing on the cycle. Now, this cycle's been unique. They probably got higher than they initially planned. So maybe that sort of situation doesn't apply this time. So I'm open-minded to anything. All I'm saying is that if the Fed were to do 50, that means the data probably deteriorated more. Okay, that's really kind of where that comes from. And that would suggest that probably the labor market in particular deteriorated more. And that's how the bond market's pricing it right now, right? I mean, they're basically saying a 25% chance of a 50 basis point cut. That's not, that's much less than it was 2 weeks ago.
Mike, let's squeeze in some sector preferences as well. I know you're not a big fan of consumer discretionary based on the conversation we've just had. Industrials, how do they fit in? Why do you like that part of the market so much right now?
Well, I would say, we don't love industrials here. We're just saying in the in the cyclical bucket, you got to own something, right? You can't just be totally naked on cyclical exposure. And if there is one group that we would gravitate towards, it would be the industrial sector, that cyclical preference is there. Within technology, which is a cyclical group, I would say we would skew more towards software rather than semiconductors or hardware, simply because they're more defensive, but it is cyclical still. So those would be the two cyclical groups that we would like in conjunction with our defensive bias, which is utilities, healthcare, staples, and real estate.
Mike Wilson of Morgan Stanley. Mike, always great to catch up with you, sir. Looking ahead to the big one for them, not the Chairman Powell address later this morning, the bigger one for them, September 6th, the payrolls report for the month of August. Would you share that view as well, Priya? Do you think the data ultimately is the more important factor here?
It is. I mean, all we're going to get here today is really the reaction function and the risks around the outlook. So I am going to watch what does Chair Powell say about risks. Are they balanced or are the risks to the downside increasing? But it's ultimately the Fed's assessment or Chair Powell's assessment, the reaction function. That's all we're going to get today. Then we're going to look for ISM as well as that all-important payroll report. And within payrolls, it's not just that headline number. The unemployment rate, I would argue, might be a little bit more important because as we saw with the revisions, that payroll number you have to sort of take with a big pinch of salt.
Keep hearing the same date, don't we? September 6th for payrolls, just a few weeks away. Coming up next on the programme, Priya will stick with us. We'll catch up with Sarah House of Wells Fargo, ahead of Fed Chair Jay Powell, and the view on the labour market from New York City. You're watching Bloomberg Surveillance. So we are about 90 minutes away from hearing from Chairman Powell in Jackson Hole, Wyoming, addressing the annual Fed get-together. But ultimately, we're all selfish, biased people, aren't we? It's about us. It's about Wall Street and financial markets. Right. Equity futures on the S&P up by 0.5%, up by 0.75% on the Nasdaq 100. On the Russell, the small caps up by 0.4%. The scores in the bond market look like this on a 2-year. In and around 4%, no drama here. The 10-year 384.63, a 30-year at about 412. Yields climbing yesterday and closing through 4% on a 2-year following better than expected jobless claims, or rather inline jobless claims, which these days is a beat. Inline is good for the economic data when it comes to the jobs market. Let's turn the page, switch to the board and get to foreign exchange. Still leaving the door wide open for another interest rate hike at the BOJ. Governor Ueda overnight, stimulating just a little bit more yen strength. Dollar yen down to 146.12. We're negative there by 0.1%. That's some of the price action. Here's some of the top stories. Under surveillance this morning, Vice President Kamala Harris rounding out the DNC, officially accepting the role of Democratic presidential nominee. President Donald Trump counter-programming along the US-Mexico border before a rally in Arizona later on today. Bank of Japan Governor Ueda keeping rate hikes firmly in play. Ueda testifying in Japan's parliament after a BOJ rate hike last month sent shockwaves across global markets. Ueda saying concerns about the BOJ's impact were overdone, pointing to the US economy. Dollar yen at about 146.12. And a third story, the amount of cash in money markets absolutely surging according to data from the Investment Company Institute. More than 100 billion has been stashed away in money market funds so far this month. Investors looking to take advantage of higher rates before the Federal Reserve begins easing policy. Priya, a big question for you on this front. What would it take to unlock that money, unlock that cash?
I think the Fed has to start cutting and signal that it's not just one cut, it's a series of cuts. And we've been hearing this from Fed officials. Gradual, methodical, suggests that the market pricing of rate cuts is not aggressive. They're going to cut to some estimate of neutral, perhaps more. But I think you need to see these few cuts come in. And then I think if I've been sitting cozily in money market funds getting 5.5%, and then I see, oh, actually that's 5, it's going down. And then I start thinking about where is it going to go down to? Well, it might go down to 3%. Okay, well, can I lock in higher level of rates? And you look at bonds. I mean, I think I hear a lot of clients saying, well, we wish we had bought at 5% on the 10-year. Okay, we're not at 5%, we're at 3.85. But look at where you're getting all in, investment grade, high yield, high quality, high yield, securitized. You're getting 5, 6, 7% all in yields. So it's not too late. You're getting higher than money market rates. Money market, there's that regret factor that'll start to come in. Well, interest rates are falling. So it's going to take a while. I think in a recession, if things actually slow down, I think that money stays in the front end because people just don't know. But in a soft landing, which is our base case view, I think you're going to start to see the moment the Fed starts to cut and signal more cuts, we get the dot plot in September, that money starts to move out.
Are you noticing a change in the conversations with clients? Are those conversations changing, or are they stubbornly sitting there and saying, I'm going to wait?
They're changing. And I'll tell you, 2 weeks ago, which now feels like it was just a wobble. At that point, it felt like the world was coming to an end. I mean, I'm only joking a little bit here. But, I think at that point, bonds were a hedge. Interest rates fell. I think a lot of people who might have thought interest rates were going to be a hedge a year ago were disappointed. we actually had a small preview of what happens if the economy slows down. Interest rates fall, the more cuts start to get priced in, all in yield. So even though spreads widen, all in yield on fixed income actually came down as the economy slowed down. So correlations were alive and kicking in front of you, and we've now heard it's not a hope trade. The Fed needs confidence. They're getting that confidence, so the Fed's going to start to cut. So I think that the conversation from clients is, okay, we want to put money out of cash. Where do we buy? I think that's more the question.
Things are slowly starting to change, and then all at once over the last few weeks. It didn't feel like the world was going to end unless you were positioned in the wrong way in dollar yen at a certain point. That Monday morning felt pretty brutal. We're counting you down to that Federal Reserve address from Chairman Powell at 10 a.m. Eastern Time. Sarah House of Wells Fargo writing the following. Powell may frame possible easing in terms of a risk management approach to policy. His speech is likely to hint that a rate cut is coming. We expect him to stop short of offering any clues as to the size of a potential rate adjustment. Sarah joins us now for more. Sarah, let's go through it together, and welcome to the programme. We've heard from Federal Reserve Chair Jay Powell a few times over the summer. We had a meeting at the end of July. We had the minutes only this week. What's the next logical step in the communication from the top of the Federal Reserve?
Yeah, so I think it is going to be this increasing emphasis on the softening that we've seen in the labor market and how the risks are more balanced is what the Fed's been saying. But I think we'll be listening for, are those risks now balanced? Are they maybe even possibly tilted towards the labor market rather than inflation? And so I think it's that ongoing transition away from inflation and looking at the more balanced risk between the Fed's two mandates.
I remember a conversation that you and I had about a year ago about the difficulty of the last mile. Everyone was focused on it, the difficulty of getting from 4 all the way down to 2. We haven't yet completed that last mile. Sarah, have we given up on it?
I think there's been a little bit of an implicit giving up, to use your phrase, where I think, in our projections, we only have inflation getting down to about 2.25%. But I think the Fed can live with that if it's weighed against the context of a potential downturn and actual deterioration in the jobs market. So I think when you look at how far they've come on inflation from over 7% to now 2.5%, that last quarter point or so, I don't think it's going to be a deal breaker if it means preserving the other side of their mandate.
Sarah, in terms of the unemployment rate, how much of that increase do you think has been about labor supply versus the fact that the labor market might be slowing? I think that's the key as we sort of parse through the labor data, which we're all focused really on that September 6th number. How much do you think it's about labor supply versus demand?
Yeah, so we've looked at this and thinking about it almost in a SOM rule-like perspective, where how much of that increase in the SOM rule indicator has been driven by new entrants or re-entrants to the labor force versus those who are actually losing jobs. And we found that about half of it is due to the increase in entrants. So that's much more than what we would typically see if the economy was on the brink of a recession. But that said, that still means that you've seen a pretty noticeable rise in terms of unemployment from permanent job losers. So I don't think we can brush the rise in the unemployment rate entirely aside just based on the labor supply story. And I think you can also see that with just the weakening in demand indicators that we see, whether you're looking at job openings, small business hiring plans, the fact that temporary employment is now below where it was in 2018, even as we have a much bigger workforce. And so, yes, it's been supply, but it's also been weakening demand for workers as well.
Do you think we're going to hear this from Chair Powell in some way? I mean, you have to read between the lines, but this idea that maybe we don't have to keep the level of restrictiveness the same, but actually reduce the level of restrictiveness, where if they're worried about the demand side of the labor market, they have to want to reduce the level of restrictiveness. But you think they're there yet? Or are you there?
I think we're getting there, and so I think the Fed's getting there. I think, in our view, we're already there, in terms of the jobs market is back to where I think the Fed wants it to stay. And so I think it's not so much the absolute state of the labor market that's a concern. Overall, the jobs market is still in good shape. It's the direction of travel that's concerning. And so I think when you look at that direction of travel and also just the overall state of the jobs market, how we do see it back to where where it was before the pandemic. In some cases, even more of a mid-2010 state. Still pretty good, but if the Fed wants to keep it there, they do need to start dialing back the degree of restrictiveness. So I think this is a speech where Powell can help explain how the Fed is thinking about its current policy setting and why some adjustments are warranted if they want to keep the labor market in good shape overall.
Sarah, does he use the word normalization? Does that come up? Is that what this is about? I think Priya's done a wonderful job this morning of drawing a distinction between normalizing things, reducing restrictiveness and going back to something in the threes versus something like going towards accommodation because of much weaker economic data. How does he frame things today?
Yeah, so whether he uses the word normalization or not, I think that's the right idea. We've seen economic conditions normalize, so yes, inflation isn't all the way back to 2%, but we've certainly seen a normalization in the jobs market, and so the policy setting has to normalize as well, especially if we do think that inflation is a lagging indicator. So that softening we've seen in labor conditions, that's going to help squeeze out a little bit more of inflation and get it closer to the Fed target. So I agree, this isn't about stimulating the economy, it's just about taking the foot off the brake and making sure we don't overshoot our destination.
Sarah House of Wells Fargo. Sarah, appreciate it. Priya, when that word comes up, if it comes up, what's normal? What's normal compared to what normal was back in 2019?
Which Powell's going to say we don't know. And they're data dependent, so we have to all figure out what that neutral is in real time. Now, I would say our star, President Williams has said it hasn't really changed. I mean, who knows? Maybe there's some small increase. If the supply side of the economy kicked in, which it did, one of the reasons why we've been in immaculate disinflation is that the supply side worked. That would argue for slightly higher R star. So I would say normal, neutral, close to 3%. And the market's essentially pricing that in. So that's why I struggle with this idea that the bond market's pricing in a high chance of a recession. We're pricing in that the Fed continues soft landing. And this is interesting because the Fed, soft landing cuts are rare. The Fed rarely has been able to engineer a soft landing, but we've gotten it so far. We're in a soft landing. And I think this is such a pivotal time. If they cut and they signal, they don't push back against the bond market, they allow the economy to get to those normal level of rates, that soft landing might actually continue. He'll go down as the best Fed chair.
Ira Jersey of Bloomberg Intelligence joins us now to complete that conversation. Ira Jersey, the potential of going down as the best Fed chair, it's not mission complete just yet. And it's unlikely we're going to hear him say mission is complete a little bit later this morning. What do you and the team expect to hear from him?
Yeah, I do think that he's going to signal that they're ready to ease, but they're going to be cautious about it. And I think that Priya's right that, he's not going to completely pre-commit. And certainly, he might talk a little bit about the developments of communication. And I think that could be something that's pretty interesting because with all the forward guidance that they're giving and with the dot plot and all of the forecasts and all the speakers that come out, there is a lot of noise and not as much signal as maybe the markets would like. And you certainly see, every time you have a Fed speaker in the market, you wind up seeing at least some volatility and some discussion just from what that one speaker is saying. And I think that we've lost kind of the narrative of the entire committee. So hopefully Jay Powell is able to say, okay, look, the committee thinks this, and here's our reaction functions. But at the same time, the economy is slowing meaningfully enough that a cut's a foregone conclusion. It winds up being how aggressively do they go after that, and the market has now priced for quite a few cuts here over the next 18 months.
Ira, you mentioned how the committee comes together. It just makes me think of Draghi back in the day. Draghi back in the day would bully the governing council into making the decisions that he wanted to make them. He would basically go out there and offer his opinion and back everyone else into a corner. They'd complain, we'd see the leaks in news outlet, including this one, repeatedly, but he'd get them to where he wanted them to be. Chairman Powell, how different a beast is he? Is he reflecting the consensus of this committee today? Is he speaking for himself? Whose voice is this?
Yeah, it's a good question. So, post-meeting press conferences, he's speaking for the whole committee. In a speech like this, he can stray from that a little bit, but I do think that he's going to be very mindful of not pre-committing and not putting words into the committee's mouth. So I do think that he will be speaking a little bit more from the committee's perspective as opposed to his own. But at the same time, look, we had the minutes on Wednesday. I very much doubt that he's going to stray meaningfully from what the tone of the minutes was, and the tone of the minutes, when you look at our natural language processing sentiment indicator, which we run on the minutes and on Powell's speech and a few other items that the Fed puts out over the course of a month, showed that they're in cutting territory, that their sentiment is dovish, and that they want to be cutting at some point in the near future. Not necessarily aggressively, in fact, but that's a little bit different than what the market's pricing. But nonetheless, the tone of the minutes in aggregate is definitely dovish.
Ira, you talk about volatility, and so I wanted to pick your brains a little bit on how do you see interest rate volatility into this easing cycle, assuming that the Fed does start it. They're talking about gradual, methodical. Does that mean interest rate vol's going to decline? Agency mortgages will do great? Or the fact, I feel like we've only been talking about the Fed, but there's payrolls, and then there's this election, which is a big one. Does that keep interest rate vol high into year end and beyond?
I think so, Priya. And as you know, we've been doing this a long time. So we understand that, liquidity isn't exactly what it used to be. And you have basically a lot of product to go through, relatively small pipes sometimes. And you don't have the balance sheet capacity in the dealer community that you used to vis-a-vis the size of the market. So I do think that volatility remained much higher than it had been, say in the 2007 timeframe. But nonetheless, typically speaking, when you wind up with interest rate cuts actually being realized and rates starting to go down, you do get sellers of volatility, right? Where people take advantage of the carry that some vol structures offer. So I do suspect that volatility will come down a little bit. Will it go all the way down to where it was, say, in 2014, 2015, when we probably wanted to, switch jobs because it was so boring about saying how many times can you, how many different ways can you say sell vol. But it's not going to be that bad. But nonetheless, I do think that you will get a decline in volatility, but maybe not until they actually cut. And I think that that's an important point. And certainly data is going to continue to have realized volatility, keep maintaining that bid for implied vol.
That's fair. And I'm glad you brought a market structure because we're moving to more price-sensitive buyers. I think every auction is going to be scrutinized by the market. But if you think about the range, so maybe we have this higher daily realized vol, but in terms of the range, where would you see the 10-year? I know the election, so let's say pre-election. Between now and the election, where would you see the 10-year range?
Yeah, I don't think that 10s are going to be able to go back up above 4% at this point. We had been in the camp that we were going to see the 10-year yield somewhere around the mid 3% range by the end of this year, and I think that we're probably going to see that again, especially as the Fed gets into its easing cycle. Because we always focus, and this is one of the issues that we have with all of the information that we get. We're so focused on will the Fed hike in September, and will that be a 25 or 50? But Priya, as you know well, that's not what's important to the 10-year. It's where do we end up, say, a year and a half or 2 years from now? And that pricing continues to be relatively volatile. Moved 11 basis points yesterday, right? When you go out and you look at what happened to Z5 SOFR futures. So as we get further and further, I think it's going to be pretty clear that the Fed does want to cut and that they are going to cut down toward 3%. And maybe even a little bit lower over the next 18 months. And that's going to basically shift the whole curve. So, 10s might rally to 3.5, but not much more than that. But the front end, 2 years, wind up rallying significantly further just on the bond math of, lower short-term interest rates mean that you get a bull steepening of the yield curve. And, that's a hard trade to stay in because of the negative carry that's involved with that. But nonetheless, if you're a cash investor, you probably want to be, looking more at the short end of the curve to get your duration budget instead of the belly or the long end.
Ira, this was awesome. As always, sir, thank you. Ira Jersey there of Bloomberg Intelligence on this bond market. Priya, I want to pick up on your point on legacy, because I actually think it's really important. When it comes to these public officials in the business of risk management, and when it comes to legacy, I think they worry more about who they don't want to be than they do worry about who they want to be and who they didn't want to be 2 years ago. were the central bank chiefs that allowed inflation to get away from them. And I just wonder 2 years later whether the fear has shifted, whether now they worry about being the central bank chiefs that allowed unemployment to climb too much and caused a recession. Do you think the fear has changed in the last 2 years?
I think it's changed. It's changed in the last 6 months, really, because I think that immaculate disinflation, when inflation is that high and so far from that 2%, you can't look at anything else. And so we became a single mandate central bank. But I think globally, as inflations come within the tolerance band, now they'll never say that their target is higher, but we're not that far from target. And the other side of the mandate has started to move. And I think, they've been saying we're coming better in balance. But I think, as you see, the unemployment rate never increases gradually. I know they're talking about gradual cuts, but you often have a non-linear increase in the unemployment rate. They have to be concerned. And it was slightly evident in the minutes that they're getting concerned more about downside risks on the labor market. I don't know if we hear that today or we hear that in the press conference in September.
Yeah.
But they have to be worried more about the employment side of the mandate.
Certainly changed a lot in 2 years, that's for sure. It's changed a lot in 3 weeks. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Hackers.
Hi, John. Let's get you some single stock movers, starting with Workday. Those shares are surging up more than 15% in the pre-market as the company signals a new focus on boosting profits. It expects it will reach an adjusted operating margin of 30% in the next 3 years. The company, which provides software around HR and other business operations, also announcing a $1 billion share buyback program. Shares of Ross Stores are also rising in the pre-market, up nearly 6%. The discount chain beating Wall Street expectations and raising its 2024 profit outlook as it saw more demand for its discounted apparel, while freight costs also eased. The company's results aligning with other retailers like Walmart and Target, which have shown consumers across the board are searching for bargains. And another stock moving higher is Cava. Those shares are rising more than 7% in the pre-market. The fast casual restaurant chain raising its full-year outlook after posting second quarter results that beat expectations. While many other restaurant companies have reported declines in visits as consumers pull back, Cava said sales at its restaurants grew more than 14%, nearly double what Wall Street expected. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, setting you up for the day ahead, the week ahead, and anticipating the big one. Fed Chair Jay Powell, live from a beautiful Jackson Hole, Wyoming, just around the corner. Live from New York City, 38 minutes away from the opening bell. Equity futures here up by 0.6%. Your trading diary, the calendar for the week ahead, looks like this. In about 1 hour, we'll get remarks from Fed Chair Jay Powell from Jackson Hole at 10 a.m. Eastern Time. Then 1 hour later, Philadelphia Fed President Patrick Harker will speak with Bloomberg, followed by Chicago Fed President Austin Goolsbee at 2:15. Wednesday, we'll get results from NVIDIA. Thursday, another round of claims. And Friday, we'll get US PCE and UMich consumer sentiment data. Turning to the main event today, Chair Powell speaking in just over 1 hour from now. Bloomberg's own Tom Keene, Bramo, joining us now from Jackson Hole, Wyoming. Guys, it looks beautiful as ever, Bramo. Is TK behaving? That's all we want to know on this side of the world.
Of course. Always. He is always behaving. Maybe. Are you
Maybe.
behaving?
I'm trying to be on good behavior. What we need to tell John, though, very importantly, as we go to this, is there were only 3 spiders in my cabin last night.
Oh,
so
boy.
It wasn't
Here, we're going to go there.
I looked under the bed for snake. A rattler wasn't there. What do we got?
Today is going to be really about defining gradual. Doesn't mean 50 basis points. Doesn't mean a 25 basis point rate cut. It's going to be setting up this market and this Federal Reserve for a rate cutting cycle. As you can see, it's a little bit smoky here. There are forest fires that are making it a little bit less clear, and maybe that's sort of a signal of the lack of clarity about where we are and whether we'll nail this soft landing.
The big thing to me is a calendar item here, and that we've got to get to September 6th in a jobs report. There's no way Chairman Powell's going to front run and be embarrassed by a September 6th report, as they were somewhat embarrassed or adjusted by an $800,000 jobs revision. So I look for a pretty much straight arrow speech. I don't look for a lot of surprises.
Well, we shall see. I will also wonder whether we see any dissent, because it's been a very long time, the second longest time in modern history, where we have not seen any dissent on this Federal Reserve. John, we'll be talking with a lot of Fed presidents. I'm very excited for the next couple of hours.
Lisa, choosing her company well. Remember, with the Bears, you just have to be faster than the next guy. That's what's important here. Bramo, thank you.
Thank you.
Alongside TK. It's beautiful,
I'm in
guys.
training.
Looking forward to the coverage. Thank you. Thank you very much. Priya, final word, please. What's the final word from you going into this address from the Federal Reserve Chair?
I'm going to be looking for a framework, context around those rate cuts. We know they're likely to start to cut rates. We know it's a cycle. I think the 25-50 is not that important. It may sound like sacrilege, but it's not. It's really what's the total amount. How are they thinking about the rate cuts? Soft landing rate cuts are rare. So provide us a sense of, is this just normalization? We want to keep the same level of restrictiveness. We want to start to reduce restrictiveness. How does the Fed chair think about risk to the outlook? So I'm going to be watching for all that. You may have to read between the lines. I don't think it's going to be an 8-minute speech. He has to talk a lot. He might also talk about the framework review. There's going to be a framework review next year. Does he set it up? And this is the perfect place to start to talk about things like framework, context.
It's almost right. You don't want to get out in front of the committee. You don't want to get out in front of the payrolls report on September 6th either. There's a lot of work still to do before we get to September 18th, which is the next Federal Reserve decision. The 6th is the payrolls report. The 11th is CPI. Priya, this was great. It's good to see you. Thanks for the last 60 minutes. Appreciate it. Thank you very much. Coming up on Monday, here's the lineup for you. Some reaction to Chairman Powell and the address a little bit later. Here's the reaction on Monday. Peter Cheer of Academy Securities, former Fed Governor Betsy Duke will catch up with Liz Ann Sodders of Charles Schwab and Michael Collins of PGIM. From New York City, thank you very much for choosing Bloomberg TV. We're about 34 minutes away from the opening bell and about an hour and 5 minutes away from Chairman Powell in Jackson Hole. From New York, this was Bloomberg Surveillance.